high and Indus Towers up. And private life insurers see bumper March new premium collections rising on a tax break expiry, but stock slip on fears that the best is behind. Even ICICI Prudential life insurance skids despite a strong showing. Bajaj Auto chief Rajiv Bajaj says he doesn't see the logic of a 1.5 lakh rupee two-wheeler subsidy, adding that India can't build a future on SOPs. He also doesn't see the phasing out of FAME having a long-term impact. On another note, he reveals the Triumph model will be unveiled on the 27th of June in London. Hi guys, good afternoon and welcome to Business Lunch. I'm Pavitra. Those are all of the top headlines that we have for you this afternoon. It is a lot about individual stock-specific action because once again on the frontline index, there's not too much happening, although there has been a bit of a slip that's come through in the past few minutes. So we're now around 50 points in the red for the Nifty, 0.3% gone there, and pretty much at the low point of the day. We're seeing a bit of a reversal in terms of what's happening with the broader markets. All through this week, we were talking about how, the broader markets are holding up a lot better. Today, you're seeing bigger cuts come through in the mid-cap and small-cap space. So the mid-cap index down over 220 points right now. Small-cap's also seeing a near 0.7% cut. The advanced decline is pretty heavily tilted in favor of the declines right now. So that's something that we are tracking as well. In terms of sectoral moves, you've just been seeing this kind of rotation play out the entire week. So today, it is really the real estate stocks and metal stocks which are a bit weak. But on the gaining side, you have ITC, which is, by the way, the top gainer on the Nifty once more. So that doing very well. And for tech, you have Wipro, TCS, HCL Tech, which are all doing very well. Cyient from the mid-cap space as well. They've seen a big recovery from the lows. But on the downside, something like a Tech Mahindra still seeing cuts, perhaps because of the downgrade that came through from JP Morgan. So that's what's happening in terms of market action. We will talk more about that, but first up, let's begin by talking on exactly this on the tech stocks. The third of the four major IT companies posted results, that's HCL Tech, and it reported quite a steady quarter. Earnings were also in line with what was expected. The revenue growth guidance that the management has provided is better than what was expected, in fact, and the management has highlighted that the deal pipeline is also near an all-time high. So let's listen in to what they had to tell us. This is the word coming in from MD and CEO C. Vijay Kumar on the numbers and the outlook.
The year started very well. Second half has been a little soft. And in spite, if you compare it to our expectations, the couple of verticals, tech and telecom, primarily in our engineering and R&D services, the revenues came lower. Maybe about $20 million came lower than what we expected in engineering and R&D services. And that was mostly attributed to the tech and telecom verticals. As we move forward, I do think most verticals have stabilized based on the rigor of execution and the ramp-ups that we have done for some of the large deals that we won in financial services. We expect FY24 to be a very strong year for financial services. Yeah, see, our revenue in BFSI is about 20, and last quarter was about 21%. And of that 21%, only 1%, less than 1% is exposed to smaller banks and the bank that you are referencing. And even within that, there is a run this business spend and the change. So it's really negligible.
All right, that is the word from the HCL Tech management. But staying with IT, the other big earnings that came through were from the mid-cap IT space. Cyient surges after it posted a good set of fourth quarter numbers. The company posted strong growth in the revenue as well as on the margin front. There's been an expansion. And their FY24 guidance is also pretty much in line with the constant currency revenue growth seen at 15 to 20%. This is for FY24. And for margins, they see a rise of 100 to 200 bips. So earlier we spoke with the management, the managing director and CEO at Cyient. So let's listen in to what he had to tell us.
We've taken into account some degree of macro uncertainty, which we all can't escape. But taking into account some degree of macro uncertainty, we're still quite confident that we have a run rate towards that number essentially in Q4 of this financial year. There is still a lot of work to do, but we believe, will we be there? Surely thereabouts, but we're working hard towards getting there. So that's still a line of sight. There are some obvious risks in areas like semiconductors where there is a slowdown that is anticipated. But I would say, I think now we have a well-diversified portfolio. If you look at the 4 reporting sectors that we have, which is transportation, sustainability, connectivity, and new growth areas, they're all very balanced. I mean, they're all, a fourth each of the services business. Or if you add the manufacturing business, that's also about the same scale. So these 5 pillars that we have, I think, are working out very well. And let's face it, right? There were times when some of the sectors that we were in did not perform very well compared to the others in the market. And I'm referring to the aerospace sector here particularly. But now that sector has come back quite strongly. So I think we've positioned ourselves quite well.
All right, that is the word coming in from Cyient. But let's now talk about the big earnings that we have to watch and that will come out either post-market hours today or over the weekend. The first one is, of course, Reliance Industries, all set to report Q4 FY23 numbers this evening. So Sonia standing by the ball with all of the expectations this time around. Sonia.
Well, it's a big day. Reliance Industries is all set to announce its Q4 earnings. Remember, the stock is down 7% in 2023 so far, but it's a decent quarter expected this time around. First, let me take you through all the key numbers that you can watch out for. On the revenue front, it's about an 8.5% growth that we're looking at compared to last quarter. While on the EBIT, the EBITDA could see a growth of around 5.2%. Margins could be a tad bit under pressure compared to what Reliance did last quarter. But on the profitability front, it's a 12% growth that we're looking at somewhere around 17,700 crores. Now, as I said, both the consumer as well as the commodity businesses for Reliance Industries have done decently well this time around. First, let's take a look at the oil to chemicals business, which is the key reason for the recovery this quarter. There's a sequential recovery that we're expecting for a couple of reasons. A stronger base gross refining margins and lower windfall tax is something that can aid this segment for them. In fact, looking at the gross refining margins, Singapore gross refining margins improved to $8.2 a barrel in Q4 compared to $6.3 a barrel last quarter. There's also a demand improvement seen because of the China reopening, and that has aided the numbers this time around. In the consumer-facing businesses, Reliance Jio has slowed down a tad bit, so we are seeing the revenue and the profitability growth moderate for them. In fact, it could be the lowest in the last 7 quarters. On the average revenue per user as well, it could be absolutely flat this time around at 178 rupees. A couple of reasons for the slowdown, but primary reason is that there's been an absence of a tariff hike, and that has caused Reliance to see a slowdown in its growth rate in the telecom business. Let's move to retail now. Retail growth is expected to be about 6% on a sequential basis, coming in at a little over 46,650 crores. These are the recommendations put out from Nomura. And on the EBIT side, we're expecting about 3,800 crores versus 3,600 crores last quarter on a sequential basis. So clearly, as you've seen, there's a decent growth expected. Some of the businesses like Rel Jio could see a bit of a slowdown, but it could be offset by good growth in the oil to chemical space.
All right, Sonia, thanks a lot for taking us through the overall estimates, but we have been telling you about the individual verticals as well. So let's talk about Reliance Retail now. Like Sonia was pointing out, we are expecting to see strong growth this time versus last year. So Mangalam is here with a little bit more of a deep dive on what we can really expect from the retail vertical this time around.
Well, for Reliance's retail business, it's already been on a big growth path. So this time around, year-on-year growth as well as quarter-on-quarter growth is something that the street is working with. Remember, usually post the third quarter, there is a slump, but the company's store expansion will offset this post-festive season slump as well. And year-on-year, the numbers will look much better because of, one, the network expansion, and secondly, a strong, favorable base for the company because of Omicron-related issues in the same time last year. So quarter-on-quarter, revenue is likely to grow by 4.5%. For the first time, it crosses that 70,000 crores per quarter mark. The EBITDA grows by 2%, just under that 5,000 crore mark, which means that the margins for the company meander around that 7% mark itself. These are Nomura's expectations. Year on year, like I said, a 22% growth in the revenue looks much better, a 31.5% growth in their EBITDA as well. The company's foray into the FMCG business, Independence, the brand that they launched a couple of quarters ago, is something that we'll be watching out for. Apart from that, they've expanded their horizon as well, entered into the personal care and home care categories too. And more than anything else, they've recently launched the beauty care platform too. So these are some things that we'll be watching out for. The heat wave is on, so the acquisition and launch of Campa as well as Socio is something that the street will be watching out for, but that may be more of a first quarter phenomenon, and eventually Metro AG's India business coming into them is also going to help the retail business grow the growth path that it already is on.
All right, that is on Reliance Retail. Mangalam, thanks for that. Standard Reliance disclaimer on your screen. The channel that you're watching is owned and operated by Reliance. But with that, we are going to talk about the other big set of earnings that you need to watch. That is from ICICI Bank. They're due to report their fourth quarter numbers tomorrow. By the way, the stock has also slipped quite a bit. Like you can see, it's at the low point of the day right now. So we are seeing a bit of a slip ahead of its fourth quarter tomorrow. So Abhishek is standing by to tell us what we should really expect from the banking major. Abhishek.
ICICI Bank is expected to report numbers tomorrow, and as per analyst poll, the street is anticipating the highest NII growth rate in last 8 years, which will lead to all-time high in terms of quarterly profits, nearly about 8,900 to 9,000 crore as per our poll. So what are the key things to watch? Loan growth that is expected to be around 18% YOY and more than 4% sequentially, which is as per Phillip Capital estimate. The net interest margin is expected to improve. So quarter on quarter, Phillip Capital is estimating net interest margin to be at 4.7% versus 4.65% in the previous quarter. This 4.7% could be a 8 to 10 year high in terms of net interest margin or at all-time high. So provisions to decline quarter on quarter due to decline in stress assets in the balance sheet. Phillip Capital estimates slippages at 5,000 crore. Previous quarter, it was a little more than 5,720 crore. Phillip Capital also expects, asset quality to improve. So gross NPA as per them could come down to 2.9% when compared to 3.1% in the previous quarter. Now watch out for two key numbers how that book moves. One is the watch list, which is about 0.57% of the loans, and the restructured book, which is about 0.5% of the loans. So our poll suggests NII growth of nearly 36% YOY and about 4% sequentially. We are working with a profit growth of nearly 28% YOY and about 8% sequentially. Back to you.
All right, Abhishek, you have a busy Saturday cut out for yourself tracking the results of ICICI Bank. We will, of course, react to these on Monday. ICICI along with Reliance. Also, Hindustan Zinc will be posting results. So that's everything that we're tracking on Monday. But for now, let's talk about the electric vehicle space. There's a lot going on here. We've been telling you that the Indian government is not in favor of extending the EV subsidy scheme, that is the FAME scheme, beyond March 2024. So, however, we do know that a final decision on this has not been taken, but this is the talk so far. Earlier today, we spoke with Rajiv Bajaj, who is, of course, managing director at Bajaj Auto, to get his take on the subsidies and pricing cap for these vehicles. And he says that he's not really a fan of subsidies of any kind. Check it out.
I have not understood what the logic is for a cap on two-wheeler pricing, for example, to be 1.5 lakhs of rupees, because that is the bone of contention as I understand it. I mean, today you can buy a 20 lakh car and get a 2 lakh FAME subsidy on that, and that's absolutely fine. But I cannot buy a 20 lakh motorcycle and get a 2 lakh subsidy on it. Why? 50,000-60,000 is, of course, not small for any consumer. In the last 3 years, the prices of two-wheelers have gone up by about that much, as you know, for various reasons. And you've seen how that has impacted demand. I am not a fan of subsidies of any kind. And I do not think India is going to build a EV future based on subsidies. Subsidies going away, in my view, should not really have that big an impact in the long run, because the future of EVs in India will be built on the back of sound strategy, not subsidy. Subsidy is not a strategy, and in my view, subsidy disrupts strategy, subsidy masks reality, and subsidy blunts innovation.
All right, that is the word coming in from Rajiv Bajaj on this entire EV space. But with that, it is time for our first short break on this show. When we come back, we're going to talk about the entire world of AI, which is getting smarter and hotter. Is generative AI a risk to tech companies? We'll talk about that in our special segment, Clutter Breakers.
The movie Three Idiots was the first time many Indian households got acquainted with the concept of drones. And prototype of the drone used in the movie was developed by a homegrown startup called IdeaForge. IdeaForge is now a pioneer in the Indian unmanned aircraft systems with a market share of nearly 50% in 2022. The company has nearly 20 patents registered. It has deals with Indian Armed Forces, state police forces, and organizations like DRDO. In April 2022, it backed $20 million in its Series B funding round from several investors, including Florentry, Infosys, and Exim Bank of India, among others. India is getting excited about the flourishing drone industry as it aims to be the global drone hub by the end of the decade. These steps like liberalization of the drone rules, rationalization of the norms of the drone pilots, and establishment of the drone schools have given new direction to the industry. The recent allocation of Rs 120 crore under the PLI scheme in the recent union budget acted as a booster dose for the Indian manufacturers. Even just a few years ago, drones were considered a niche industry, but now investments are starting to pour in. Ankit Mehta, the CEO of IdeaForge, which was formed in 2007, has witnessed a complete transformation in government policies and investments throughout the years.
I've in a way seen the drone regulations go from ignore to deny to accept to support. That whole cycle we have seen, right, from the very beginning. And absolutely, we are delighted to know that now it is a regime that is enabling. It is a regime that wants to deploy these systems in an environment where we will now be able to take these systems and utilize them.
Welcome back. You're still tuned into Business Lunch, and let's talk about ChatGPT now, because it has clearly become the latest buzzword no matter which tech company we talk to, and it is being heralded as the future. But can it really be a big disruptor? Will it eat into IT jobs as well? Rima is here to bring us a roundup of what we know so far and what some brokerages also are saying on this. Rima.
So let's start with what generative AI like ChatGPT can do. Well, it generates content that is indistinguishable from human-created output. Think of it as a software writing a software. So you no longer need handwritten code written by engineers to develop a code for an app, for instance. You can do it via prompts. So the question is, if you can write code, I can write code, then what happens to all of India's engineering talents? Is there a risk to software jobs? Well, it's hard to say right now conclusively, but experts do believe there is a possibility that lower-end software jobs can get impacted. There was a recent Goldman Sachs report which said the shifts in workflows triggered by these advances could expose the equivalent of 300 million full-time jobs to automation. But this is a number which is across industries, not only for the technology industry. But remember, till AI gets very sophisticated, extensive human input will be required to validate the output, to check the output generated by, say, a ChatGPT. So how can this play out for technology companies? Well, for starters, IT companies may need to hire fewer people. That will help with their productivity. And there is also a possibility that at some point, the productivity benefits generated by generative AI can get passed on, which means customers are saying, give me some discounts because now you need less money to write that code. From an enterprise point of view, that's the customers of the IT vendors. Will enterprises cut their technology spend because writing code, software development now takes less effort? Or will they keep their technology spend intact and use the productivity savings to focus on more technology projects? And also, the bigger and the more important question is, when does the significant impact of AI generative advancements start kicking in? Does it happen as soon as 3 to 6 months, or is this something which is going to take time, 2 to 3 years, to become sophisticated? And I don't want to sound apocalyptic, and just to balance out the other side of the argument, worker displacement, which is generated from automation, historically has been offset by the creation of new jobs and the emergence of new occupations following the technological innovations. This is something that Goldman Sachs says, and they believe generative AI will complement and not substitute the workforce.
All right, Rima, thanks a lot for getting us that very interesting piece on generative AI. But with that, let's move on and also talk about UK-based coffee chain Pret a Manger, which has opened its first store in Mumbai's BKC area. The coffee chain opened up in partnership with Reliance Brands and will also open a store in Gurugram in a bit. So Shilpa is here with the details on that. Shilpa.
UK-based coffee chain Pret a Manger has opened its doors to India with the launch of its first store here in Mumbai's BKC. Now, this foray into India is in partnership with Reliance brands and is set to take on the likes of Starbucks, Barista, etc. Now, this store is a recreation of London's spread coffee shops, which are spread over large dining areas with an area of over 2,500 square feet and offers fresh on-the-go food along with coffee. Now, this BKC store will be followed by another store in Palladium in the next 15 days, and another coffee shop will open 15 days later in Gurugram. In Mumbai, Shilpa Ranipeta.
Shilpa, thanks a lot for that. That's definitely exciting news for a coffee enthusiast like myself. So I'm looking forward to checking it out. But with that, let's also bring you some important national news. This comes in from the Poonch district of Jammu and Kashmir, where 5 soldiers were killed and 1 injured after an Indian Army vehicle was fired at by terrorists from the Lashkar-e-Taiba group last evening. And this is according to Jammu and Kashmir police. The terrorists used assault rifles and rocket-propelled grenades to fire at the vehicle, leaving the army truck engulfed in flames. Remember, this is the 4th such incident that has involved casualties in the Poonch district. All right, very unfortunate and tragic news coming in there from Jammu and Kashmir. But with that, we are going to get into a short break now. On the other side, what we're going to talk about is the withdrawal of the blue ticks. Thousands of Twitter accounts have lost their verified status as well as the blue ticks. So we'll bring you more on Elon Musk's push for a monthly subscription plan when we come back.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points.
Welcome back. You're still tuned into Business Lunch, and it has finally happened. Thousands of Twitter accounts have lost their verified status as part of Elon Musk's plans to push for a verification through a paid monthly subscription plan. So several celebrities, business leaders, politicians have all lost their blue ticks, while some have, of course, retained it by either paying for the subscription. So Kanishka Sarkar is here with more on that.
Well, this time it's for real. If you haven't paid or Elon Musk hasn't paid for your Twitter Blue subscription, or you're not ahead of a state, then you've lost the blue tick against your Twitter handle. After several false starts, Twitter has finally pulled the plug on legacy verified accounts. Be it Shah Rukh Khan, Rajnikant, Virat Kohli, Sachin Tendulkar or Anand Mahindra, even political accounts like those of the BJP, Congress leader Rahul Gandhi and many others have lost their blue ticks. International personalities like Beyonce, Pope Francis, Mark Zuckerberg and Donald Trump have lost their ticks too. In fact, even Twitter's founder, Jack Dorsey, doesn't have it anymore. All of them have millions of followers. However, not all celebs have lost it yet. In India, several actors, especially those from southern India, have subscribed to Twitter Blue. Kamal Hassan, Nagarjuna, Mahesh Babu and Junior NTR to name a few. Apple CEO Tim Cook, singer and actor Rihanna, Indian businessman Harsh Goenka also seem to have paid and retained their blue checks. While Twitter had about 3 lakh verified users under the original blue tick system, many of them journalists, athletes and public figures. But now, if you want a blue tick, in the US you need to pay about $7 a month, while in India it costs around 900 rupees a month or a discounted rate of 9,400 rupees a year.
All right, Kanishka, thanks a lot on getting us all of the details. So that is the latest on Twitter. But as we wind down on this working week and we gear up for the weekend, remember India will be celebrating both Eid as well as Akshaya Tritiya tomorrow. Preparations for festivities have begun in full swing after a month-long period of fasting for India's Muslim community. Meanwhile, jewelers will also be flocked by buyers who will be buying gold on the occasion of Akshaya Tritiya, which remember is considered one of the most auspicious days for a new beginning. All right, in case you're not celebrating Eid and you're also not celebrating Akshaya Tritiya, don't worry, there's something for you as well, because for all the Salman Khan fans, get ready. There is a blockbuster weekend coming up as the Bollywood superstar is back after 4 whole years with Kisi Ka Bhai Kisi Ki Jaan, which releases today ahead of the Eid weekend. The movie is an action comedy and also stars Pooja Hegde and Telugu star Venkatesh. The craze for Salman is likely to nudge the movie to a good box office number as well.
कोई जान देता है, कोई जान लेता है.
So that is the latest and everything that you can do on this weekend as we, wrap up on this week. But with that, I'm going to take your leave on this edition of Business Lunch. Thank you guys very much for tuning in, and we have Midcap Radar up in 2.
We're so fortunate, almost all of us, that we have no idea what it is like to be on the front line in a war facing bullets and missiles and rockets. What is it like? Let's hear from a soldier who was there, who was fortunate enough to have returned alive, even if he lost a leg. Life as a soldier is never easy, but those were happy days for Nikolai Lukash with his buddies on the front lines before the war hit. The war is still here, and so is the trauma for those who have seen the worst of it. I was posted close to Mykolaiv. I was in the Marines. Then we were posted to Mariupol to replace the 128th Infantry Brigade. The invasion we were expecting came on February the 24th. The Russians broke into Mariupol and surrounded us. The ring around us became closer and closer. Then they began to bomb us. Everything around us was destroyed. We ran out of ammunition, food, water. There was nothing left. We put up white flags over our bunkers, and still Russians kept bombing us, hitting us with rockets. Thousands and thousands of soldiers and civilians were killed. We kept trying to fight the advancing Chechens from the Russian side. We tried to evacuate, but we had been surrounded. I was hit by a shell. I was taken prisoner and then to a Russian dugout. When I reached it, I realized I had lost a leg. I was returned to Ukraine in an exchange of prisoners. I was treated in Zaporizhia and then in Kiev, where I was given an iron leg. I will not be serving in the military for a while, but I will recover and fight again for Ukraine's victory. Walk along the streets of Kiev, of Kherson, of Kharkiv, and not a lot of people have a lot to say. Well, in Kherson, there's nobody around to say anything. In many parts of Kharkiv, there's nobody around to say anything on the streets. But war is on everyone's mind. How do you read that? Read it on the walls, on the paintings, the figures, the graffiti, the posters. Some people have said it there, others are seeing it there. Let's some of what Ukraine is saying without actually, of course, saying it. By the Krishatik Street in Kiev, a row of posters remind passers-by of their Ukrainian past, as distinguished always now from a Soviet and particularly Russian past. Along the Freedom Square in Kharkiv, the word is out.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra, and with me today is Ekta Batra. A lot of action in the markets. We are seeing a swift recovery as far as the Nifty is concerned, down to around 40-odd points, but a lot to discuss. So we'll just do that. Hey, good afternoon, Ekta.
Hi, Sonal. Yes, absolutely. It's turning out to be a session where, the mid-caps, which have been outperformers all this while, are now seeing some amount of significant profit booking relative to at least what we are seeing on the Nifty and the Sensex. So we have the mid-cap index, which is up down around 0.6%. And the Bank Nifty as well, which had been outperforming, is now seeing a bit of profit booking. So down around 0.5% currently for the Bank Nifty. ICICI Bank numbers tomorrow, that'll be important to watch from a market perspective. These are our top stories this afternoon. Cyient shines in the fourth quarter, delivers a strong guidance for FY24. Management tells CNBC-TV18 they expect the transportation vertical to post double-digit revenue growth. Emphasis slips after JP Morgan downgrades the stock to underweight and cuts the target, citing challenges in BFSI, telecom, high-tech, manufacturing and retail.
ICICI Prudential slides despite strong fourth quarter. Management tells CNBC-TV18 there is further potential of doubling the value of new business in the next 3 to 4 years.
Sterling and Wilson Renewable Energy slips as losses widen in the quarter. Its unexecuted EPC order book stands at sharp 4,900 crores at the end of FY23.
Okay, all right, those are the top mid-cap headlines that we are tracking for you. The markets are seeing some recovery from the lows, and that is an accelerated recovery, so to say. 29 points lower on the Nifty right now, and it's courtesy Bank Nifty. The Bank Nifty is down 184 points, and that is something that is leading to recovery on the Nifty as well. Mid-cap side of things, they're actually underperforming, but it will be important to track whether we continue to see this recovery and that sustains or not, because the pattern of the market has been quite sideways in last couple of trading sessions. We'll do one thing. We'll move on and talk about the mid-cap index and some mid-cap movers as well. This is our special segment, and Vivek is with us, as always, to take us through the mid-caps, which are moving around in trade. Vivek.
Well, thank you so much for that. After a while, we are actually seeing a bit of underperformance. Let's call it profit booking for the time being, given the fact that we've actually seen a significant and sustained period of outperformance as far as the broader end of the markets are concerned. Some of the names today that are moving on very strong volumes as well. First on our list, Dish TV, we'll wait and watch for any news flow that could come out in this particular name. After a while, up almost 15% in the session. Heremba Industries, not a name that we discuss too often, but the stock is doing very well in this session after a while. Two more names, Lumax Autotech up on strong volumes today, and Borosil Renewables after a while is seeing a bit of a spike up in the session today. Some names that are doing well on very strong volumes are Mahindra Holidays after a while is seeing very strong volume action in the session. FDC Limited is up almost 7%. Eureka Forbes as well as Marks & Pharma today are doing quite well with good volume action as well. On the other hand, it's a mix of earnings as well as some of the stocks that have seen a bit of a run up in recent times that are seeing profit correction. Sterling and Wilson Solar is now down almost 6%. Gujarat Ambuja Exports, this particular stock was an outperformer in the week gone by, seeing quite a bit of a sharp correction. Gland Pharma as well as City Union Bank both seeing profit booking at higher levels.
All right, Vivek, thanks very much for that. So a lot of earnings which are standing out in today's trading session, or rather earning reactions. But good time then to get a technical check-in. Himen Kapadia of KR Choksi Securities joins in for what he's tracking in terms of the end of the week. Himen, hi, welcome to the show. Well, what is your sense? Because specifically, I actually wanted to start by asking you about the financials, because that has been relatively better as compared to the Nifty and the Sensex. Now we're seeing profit booking seep into the Bank Nifty. How would you approach it?
A very good afternoon, Ekta. Thank you for having me on the show. Like you said, they were outperforming. Frankly speaking, the laws of gravity need to work. The Nifty has had a 1,000-point rally. The Bank Nifty has had a humongous move. And like you said, the outperformance there. Gravity is catching up. And now also we have an expiry week coming in. And if you see the retracement, what I mean to say is the rise has been good, quite solid as far as the Nifty and Bank Nifty. But the Bank Nifty is refusing to decline further. What I mean to say is, comparing the size of the rise, the decline has been quite shallow. So the undercurrent remains good. The VIX is below 12, so I don't expect anything majorly happening, not a big move. But yes, what could happen is we could spend a few days consolidating, moving sideways in a tight range. But more importantly, everything seems hunky-dory. It is a correction within an up move. So the outlook remains positive. I wouldn't be unduly worried. And I also believe that this could be an opportunity to buy certain stocks if you missed out on something, because the move which started from 16,850, I believe is not yet over.
Oh, okay. All right. So that's the take on the index, Himain. In a market like this, where you're expecting such moves to actually take place, what would your individual technical bets be?
Okay, couple of stocks which Sonal stand out. Firstly is a buy call on Asian Paints. Okay, crude oil going down and all is fine, but on technical parameters, we've been moving sideways for around 9 weeks. Now we are beginning to see technical green shoots. The oscillators on the not only on the daily, the weekly charts have also given crossover buys. It has just closed above the 55-day exponential moving average yesterday. Higher tops, higher bottoms. Everything seems to suggest that the stock is in the midst of a decent bounce, and the bounce has some way to go. Buy on Asian Paints at 2870, stop loss 2800, target of 3010. The second stock is a buy call on Indian Hotels. We've been moving sideways over here. I believe there's an inverted head and shoulder from which it is breaking out on the weekly chart. And the consolidation phase has been almost 5.5 months. So one can buy, but it's a conditional buy call. One can buy Indian Hotels at 330, stop loss 318, target 354. I believe the all-time high is 347 and 354 is a modest target. If the breakout comes in like I think it will, I believe it will get overshot. So.
Okay. Himain, just before we let you go, I had a quick, question with regards to the entire pharmaceutical space, which has intermittently shown strength over the past 2 to 3 odd weeks. How would you approach a stock such as Divi, Cipla?
Okay, Cipla, frankly speaking, Ekta is in a bounce back. We had very strong support at 850 over the last couple of years, and that has held firm. We've fallen off a cliff from what, 1180? Short-term oversold. I think the bounce is underway. The bounce is not yet over. Overall, the pharma pack is looking a bit dicey, but Cipla is, from a longer-term point of view, Dr. Reddy and Glenmark look good, but Cipla is in the throes of a bounce, and I believe there is some more juice left in the bounce. Ekta.
Okay. All right, Himain, thank you so much for joining us today. Have a great weekend ahead. That's some technical check on the markets. We'll slip into a break now and connect with Shailesh Vasnani, who's the Vice President, Morbi Ceramic Association. We'll discuss pricing trends and demand as well. Stay tuned.
The movie Three Idiots was the first time many Indian households got acquainted with the concept of drones. And prototype of the drone used in the movie was developed by a homegrown startup called IdeaForge. IdeaForge is now a pioneer in the Indian unmanned aircraft systems with a market share of nearly 50% in 2022. The company has nearly 20 patents registered. It has deals with Indian Armed Forces, state police forces, and organizations like DRDO. In April 2022, it backed $20 million in its Series B funding round from several investors, including Florentry, Infosys, and Exim Bank of India, among others.
India is getting excited about the flourishing drone industry as it aims to be the global drone hub by the end of the decade. These steps like liberalization of the drone rules, rationalization of the norms for the drone pilots and establishment of the drone schools have given new direction to the industry. The recent allocation of rupees 120 crore under the PLI scheme in the recent union budget acted as a booster dose for the Indian manufacturers.
Even just a few years ago, drones were considered a niche industry, but now investments are starting to pour in. Ankit Mehta, the CEO of IdeaForge, which was formed in 2007, has witnessed a complete transformation in government policies and investments throughout the years.
So I've in a way seen the drone regulations go from ignore to deny to accept to support. That whole cycle we have seen, right, from the very beginning. And absolutely, we are delighted to know that now it is a regime that is enabling. It is a regime that wants to deploy these systems in an environment where we will now be able to take these systems and utilize their benefit without undue bottlenecks around the space we are operating in and the environment we are doing it, as long as we are in those green zones up to that.
Welcome back. Well, for the markets, we have indicated that there is pressure overall for the indices. We have the Nifty, which is down around 43 odd points, Midcap Index, which is down around 200 odd points. But there are specific stocks which are showing strength. ITC would be one particular stock which stands out. That stock has been a rank outperformer on a year-to-date basis. It's up around 22.6%. It's up 1.5% today and is at a fresh 52-week high. It surpassed that 400 rupee mark currently at around 406 rupees. So good going currently for ITC. So there's definitely buying which is coming into specific stocks despite weakness on the indices. But let's talk about one particular topic. Gujarat Gas has cut prices with effect 1st April 2023 in the industrial segment. Prices have been cut to around 45.91 per SCM versus 49.5 earlier. Shailesh Vasnani, who is the Vice President of Morbi Ceramic Association, and they use the natural gas which is supplied by the state in Gujarat, joins in to discuss this. Hi, sir. Welcome to the show. If you could just lay down what the impact would be for Morbi Ceramic Association, considering the cut which has come through.
Good afternoon. Right now, the cut of Gujarat Gas is really good enough for us, because the industry is also facing a very big problem in our market also. The market has gone down by 8 to 10%. But yes, compared to the Gujarat gas price of 46 rupees as you said, even the propane gases come cheaper, because the price of the propane is 60 rupees per kg. But when we compare the calorific value of propane gas with Gujarat gas, propane gas calorific value is 11,100 and the Gujarat gas calorific value is 8,300. So the comparative price of propane is still 45 rupees. So it is one other way, either it is at par or a little cheaper than Gujarat gas. But in the next month, May month pricing of propane gas is forecasted to be 52 rupees per kg. So the targeted price of Gujarat gas must be 42 to 43 to be competitive with the propane gas. So if this doesn't go down, the consumption of the propane will increase and the consumption of the Gujarat gas will go down once again.
Okay,
so
right. Yes, Mr. Vasnani, that's what I wanted to understand. Because globally, Saudi Aramco has also cut some propane prices. Has this already been reflected in the local pricing? And in anticipation of that, are you bulking up more on propane versus, say, natural gas from Gujarat Gas? What is the current mix between propane and gas?
Right now, let me tell you about some figures of the Morbi consumption. The total consumption of the Morbi is 70 lakh meter cube per day. From this 70 lakh meter cube per day, today 43 lakh meter cube has been consumed by Gujarat Gas and the rest 25 lakhs has been consumed by propane. What happens in propane is propane depends upon the import pricing, right? So the import pricing of the next month is already been declared by the company. So we have been informed that it is going to be 6 to 7 rupees lesser in the next month for the propane. So comparatively, if Gujarat Gas doesn't get down by 4 to 5 rupees, it won't be competitive in the next month. And currently the scenario is 60-40. 60% we are using Gujarat Gas and 40% is the consumption of propane in the total industry.
Okay. Can you just give us a sense in terms of what demand is anyway looking like at this point in time, and what might the utilization levels be in your plants on an average?
Right now, the total Morbi's installed capacity is 82 lakhs meter cube per day. From that installed capacity, current use is 70 lakhs. And from this 70 lakhs, 43 lakhs is Gujarat gas. But if the Gujarat gas prices are competitive, it can reach up to 100% level. In the previous years, it was almost 95 to 100% use of Gujarat gas from the total sector.
Mr. Vasnani, what my colleague meant to ask is, what are the demand trends right now generally from your consumers? You did say that demand is lower by 8 to 10%. Can you split it up for us in the domestic and export markets?
These are what I'm talking is about the domestic market. It has gone down by 8 to 10%. When we talk about the global market, it is 5 to 7% higher than the previous year. So the export market is a little growing, it's not declining. The domestic market is facing a little pressure in this year. And the total market size of our tires in India is about 48,000 crores per year.
Okay. Has there been any impact on business now that China has started coming back fully in terms of production?
No. Currently, it's a good news for India. Ceramic industry of Morbi is exporting to more than 85 countries. And in most of the countries, we are beating against Chinese goods. So right now, our exports are higher than China exports. And luckily, not many countries like Europe and USA has deposited anti-dumping duty against Chinese tires. So in that case, we have a favorable condition on those countries.
Okay. Mr. Vasnani, I also wanted to understand, with the tariff change that has come by in GAIL's pipelines, is that also making Gujarat Gas change pricing in any manner? Because that is something which was supposed to be reducing tariffs, or at least reducing costs for Gujarat Gas. Has that come by? Are you in conversation with Gujarat Gas in any way to tell them that, okay, propane prices are going down, we need a cut from Gujarat Gas as well?
Yeah, we already had the discussion with Gujarat Gas because they have a local office in Morbi, and we are also in discussion with the MD of Gujarat Gas also. So we have a regular conversation with them. But what happens is the pricing policies depend upon the Gujarat government, because government is the major stakeholder of this Gujarat Gas company. So they don't declare in advance before a month or so. So whenever there is a cut, it comes within a notice of a single day. But yes, we are also waiting for a little price cut, and we are hopeful it will be little down compared to the propane.
Oh, okay. Can you give us, what exactly the price differential could be going forward? How much of a price cut are you probably seeking at this point?
For May month, the price of the propane, what they are seeking us is 7 to 8 rupees down per kg. So compared to that price, we are seeking 4 to 5 rupees per meter to price cut down in Gujarat Gas also. So it will be at par.
Okay.
So we can use more of the Gujarat Gas.
Okay, all right. So it totally depends on what the pricing is. It has been very dynamic in the last couple of years, especially because of the way spot LNG prices have shot up and what we've seen in the global gas markets as well. But demand, according to you, is better in export markets, but has come down a little bit in the domestic markets. Mr. Vasnani, it was a pleasure speaking with you. Thank you so much for joining us and telling us all about what's happening on ground as far as the tile industry is concerned and the ceramic industry is concerned as well. Thanks a lot for joining us today. So that's the word coming in from Morbi Association. We'll slip into a short break now and get you more on the markets and stock-specific action on the other side. Stay tuned.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points. Now the market share is 17.4%, and for SBI the loss is
Welcome back. Still tuned into Midcap Radar on CNBC-TV18. While the markets are under pressure, there are some certain stocks which are buzzing in how. So some of them should come up for you on the screen. We have Dish TV, a stock that we don't discuss so often, but today it's made a sudden move. It's up around 17%, but of course, 16 rupees stock there. The other one that I'm watching out for is Nazara Technologies, 9% higher on that stock. There's no news as such, but it is making a comeback. Was at a 52-week low just 2-3 weeks back. The other one is Delivery, which is up 5%. BLS International Services also higher by 5%. They had told us here on CNBC-TV18 that they are almost higher than pre-COVID levels across all the geographies, and the Russian geography too is reopening as far as visa services are concerned. Precision Camshafts, the other one, which is at a fresh 52-week high. Some interesting block deals in that name right now. We'll move on and talk about another pocket, which is the life insurance space. Those stocks are trading under pressure. Surbhi is joining us here with what's happening despite decent set of numbers that these companies reported. Surbhi?
As we've been pointing out, that the life insurance monthly data for the month of March is extremely strong, but the stock prices are giving us a different picture. All life insurance companies are trending downwards in today's trading session, and a couple of reasons for that could be: one, this growth is being driven by the increase in the average ticket size of policies and not by the number of policies being sold. And two, this accelerated growth could impact the numbers for FY24 now, as the growth will be on a higher base. Now, all brokerages also have a similar view, but they still are positive on this life insurance space. HSBC says that they have cut down their FY24 APE estimates by 600 basis points. Kotak says Q4 FY23 was higher than their estimates, translating into a higher base, but they will wait for all companies to report their numbers before they revise their FY24 estimates. MK expects a flattish kind of APE growth for FY24. And lastly, Investec says that the budget proposals will impact the value proposition in the high-ticket segment, but according to their estimates, it is only 10 to 12% of the VNB for all life insurance companies. They're all positive for this space, but APE growth for FY24 still remains a concern.
Okay, all right, Surbhi, thanks very much for that. Well, with regards to the insurance industry now, several insurance stocks have posted their business updates and have seen a fall in the recent sessions. Yash is here with the details on this.
Well, Ekta, as Surbhi pointed out, the stocks certainly are not obliging to the strong data which the life insurance industry is posted. As far as the industry is concerned, the strong data was on expected lines. So the life insurance industry, the private life insurance space, has grown its premium by 35% in the month of March on a year-on-year basis. FY23 premium growth, that stands at 20%, and March retail annualized premium equivalent, that has grown by 56% for the private life insurance industry. The star performer here from the private pack has been HDFC Life. The March premium has grown by 83%. The retail APE has grown by 118% on a year-on-year basis. This is followed by a strong performance from Max Life, where the March premium has grown by 43%, and the retail AP is seeing a growth of a healthy 60% rate. ICICI Prudential Life, the March premium is up 31%, retail AP grows by 59%. Finally, SBI Life Insurance, the March premium seeing a decent growth of 23%, and the retail AP growing by 12%. The PSU side, which means LIC, was the weak link here. The March premium for LIC, in fact, contracted by 32%. The retail AP grew just by about 10%, which sort of took the entire industry data down, where the March premium for the total life insurance industry was down 13% in the month of March on a year-on-year basis, and FY23 could only grow by about 18%.
All right, Yash, thank you so much for joining us with those updates. With that, we'll take your leave on this edition of Midcap Radar with the news that Nifty has seen some further recovery courtesy some of these consumption names. So we'll keep tracking markets for you. Your stocks when we return.
So fortunate, almost all of us, that we have no idea what it is like to be on the front line in a war facing bullets and missiles and rockets. What is it like? Let's hear from a soldier who was there, who was fortunate enough to have returned alive, even if he lost a leg. Life as a soldier is never easy, but those were happy days for Nikolai Lukash with his buddies on the front lines before the war hit. The war is still here, and so is the trauma for those who have seen the worst of it. I was posted close to Mykolaiv. I was in the Marines. Then we were posted to Mariupol to replace the 128th Infantry Brigade. The invasion we were expecting came on February the 24th. The Russians broke into Mariupol and surrounded us. Their ring around us became closer and closer. Then they began to bomb us. Everything around us was destroyed. We ran out of ammunition, food, water. There was nothing left. We put up white flags over our bunkers, and still the Russians kept bombing us, hitting us with rockets. Thousands and thousands of soldiers and civilians were killed. We kept trying to fight the advancing Chechens from the Russian side. We tried to evacuate, but we had been surrounded. I was hit by a shell. I was taken prisoner and then to a Russian dugout. When I reached it, I realized I had lost a leg. I was returned to Ukraine in an exchange of prisoners. I was treated in Zaporizhia and then in Kiev, where I was given an iron leg. I will not be serving in the military for a while, but I will recover and fight again for Ukraine's victory. Walk along the streets of Kiev, of Kherson, of Kharkiv, and not a lot of people have a lot to say. Well, in Kherson, there's nobody.
Hi guys, good afternoon and welcome to Your Stocks. I'm Pavitra. With me is Ekta, and Ekta, we have another day of not really too much happening right in the markets. Once again, very kind of dull day of trade, but for now in the past half an hour or so we have seen a bit of a move higher. So pretty much just around 10-15 odd points in the red for the Nifty. The broader markets today for a change are more under pressure and underperforming.
Hi, Pavitra. Yes, absolutely. You know, that is something that we were pointing out, that it's the financials as well as the broader market stocks which are seeing pressure as compared to the Nifty and the Sensex. But while today might be quiet, all the action is post-markets today, correct? And we have Reliance Industries, which will be reporting its numbers post-markets. And separately, we have ICICI Bank, which will really set the tone for a lot of the corporate banks and what they might indicate from the entire banking space.
So
that
Monday
comes
may
out,
not be so quiet.
that comes out tomorrow, along with even Yes Bank, which will be releasing its numbers. So we have a lot to watch out for in terms of trade when it comes to Monday. But nonetheless, we have a whole host of queries lined up in the next 30 odd minutes. So let's introduce our guests. We have Ashish Kyal, who's of Wave Strategy, joining in, and Shaina Mukaddam, who's an independent market expert, joining in to answer all of your queries. Ashish as well as Shaina, welcome to the show. Well, let's start with the first question. We have Jitesh Kumar, who writes to us from Mumbai. He holds 100 shares of Mastech, which he's bought at around 1,000. He's a long-term investor, wants to know what he should do with it, whether he should hold or sell, given the company's good performance in Q4. Well, Shaina, you know, today we thought that there will be some amount of semblance of sanity when it comes to the IT space after the rundowns that we've seen post-Infosys, because of what the likes of HCL Tech, Mastech and Cyient reported. Do you think that this performance that Mastech reported yesterday would continue and it would be a long-term buy?
The numbers were good, and I believe the management has indicated that they are reasonably confident that this sort of performance will continue on over the next coming quarters by giving a very decent type of outlook. So I believe that valuations being extremely attractive, one can continue holding it even at current levels. So I would recommend a hold. If you see the valuations, it's, you know, for a, I would say now it's moving into more mid-cap. It used to be a small cap till recently. So it's on that borderline. But I would think that numbers are good and the prospects remain pretty robust. Valuations are decent. So I would continue holding.
Okay, continue holding Mastech. And, you know, like you were pointing out, the valuations are just around 12 times compared to some of its peers, which trade anywhere between 17 to 25 times, right? So definitely much cheaper there. Ashish, your thoughts on Mastech? Of course, we saw a big run-up after the earnings. Do you expect it to continue?
Yes, indeed, because Mastech saw a double, triple bottom formation around 1480 levels. And I think the investor has invested at 1000 levels. So that's a very good level that he is in the stock. And here we are seeing a very strong breakout that happened yesterday. Today is a consolidation phase. But there is a possibility the target of the pattern is around 2200 to 2300. So that levels can be seen shortly in the stock. And on the downside, important support is lying at around 1630 levels. So I would definitely recommend to hold the stock. I think the entire IT space is going to consolidate and then break out. So if the time horizon is at least for a year and a half to 2 years, Mastech can even reach out to 3000 levels. So the overall pattern is suggesting positivity, but the holding period should be 1.5 years or more.
All right, can reach 3000 from the around 1760 that is at right now. That is on Mastech. The next query that we have coming in is Neeti Gupta, who writes to us. She is holding 100 shares of PNB at 50 and 20 shares of HCL Tech at 800 as well. She's a medium-term investor and wants to know whether to hold or sell this one. Of course, this is a good day to be talking about HCL Tech as well, right after its earnings. Shaina, coming to you on this. I mean, she's anyway sitting on a profit there. They reported quite an inline set. The management also sounds quite positive. Would you think it's a good one to hold?
Well, I would book profits because she is making profits in HCL Tech. The main reasons being, while the numbers were in line, we have to accept the fact that, you know, revenues were lower. And if you see the guidance, it's actually factoring in, you know, a slower growth even in FY24. So I would believe that the stock having corrected, it is stabilizing at current levels. But given the, you know, the financials that are likely to emerge in next year, I think the stock will consolidate over the next 1 year rather than give you a outperform or even a market perform. So I would exit from HCL Tech and look at some other stock which is or other sector which is actually likely to perform over the 1 year, and then relook at it after a couple of quarters.
Okay, so that's on HCL Tech. Ashish, what would you recommend on that, on this particular counter? Technically, 1046 is currently where you're getting the stock. 52-week high stands at 1156.
Yes, if you look at HCL Tech and compared with the peer like Wipro, I think HCL Tech has shown some kind of outperformance. Nevertheless, we can see the pressure because of the sector, and the stock is also under pressure over past few weeks. But it has a very important support of around 1,000 levels on the downside. So as long as 1,000 is intact, I think there is a possibility over short term we can again see the stock running up to 1140. And if that level gets broken out, then 1200 levels can be expected. So right now, hold the stock with 1000 as a strict stop loss and expecting a target of 1120 followed by 1200 levels.
All right, so that is on HCL Tech. The query also has PNB because they've mentioned that they have 100 shares of PNB bought at 50. So what would you recommend here, Ashish?
See, the buying price is not so far away. The stock is currently quoting around 48.15 or around those zones. So I think 50 is achievable, and once that level is crossed, I think the stock can move towards that 54 levels also. On the downside, there is a very important support which is lying at 46. So hold the stock for short term with 46 as a stop loss and expecting a target of around 54 on the upside.
Okay, a target of 54 on the upside. If you see, it's rallied quite significantly from that 52-week low of around 28 rupees for PNB. But fundamentally, Shaina, any recommendations on Punjab National Bank? Generally, most of the PSU banks have shown stability as of last quarter in terms of what they've been reporting.
Well, I would concur with Ashish that the investor continues to hold currently with a target of about 54, 55. Basically, I'm not too gung-ho on the numbers that they're likely to report. They haven't been really reporting very great numbers, but only thing valuations are very attractive. At below 0.5 book price to book, I think valuations are there in their favor. Also, you have possible news, positive news likely if they have investments in subsidiaries of housing, also in their life insurance business with Canara Bank. So I think to that extent, there could be positive news triggers. So for that reason, I would continue holding.
Okay, all right. So that's on PNB, a positive outlook coming in on the fundamentals. We have another query now. Santosh writes to us from Pune with an investment query, wants to invest in State Bank of India, wants to know a long-term target price. Well, Shaina, if you are quite positive on PNB, then what would you think about the mother bank within the entire banking space, State Bank of India?
Well, of course, if anyone wants to be in PSU banking, SBI is the place to be in. At the same time, it's more of a portfolio stock. So I would always buy SBI in a staggered fashion. So to an extent, you can start buying now, but not everything, and keep buying it at frequent intervals because there are some negative headwinds that are there. Interest rates are on the rise. The credit cost is going up. So to that extent, one needs to keep a close watch. Also, you have the possible impact of these on the asset quality and on the loan growth. So at the same time, I would buy currently some quantity because we already have the operational numbers for the quarter. 5% plus type of growth in they're likely to report 5% plus type of growth. I would say in their deposits, and loan also book is doing pretty healthy. So price to book at about 1.5 times. I would say that one can start buying, but buy it in a staggered fashion.
Okay, can start buying SBI in a staggered fashion. Ashish, technical call on SBI?
If you look at SBI, it's moving in a very broad range of 565 to around 500, but I think the overall banking space can start outperforming, and SBI has not outperformed so far. So I'm going to be optimistic over here. I am expecting it will break that range on the upside. 560 or 570 levels will be broken on the upside. The stock can head towards the 630 levels, which is the previous peak. And on the downside, important support for the stop loss can be around 520 levels.
All right, that is on SBI. Now we have another query coming in. This one is from Mihir, who writes to us from Dehradun. He holds 2,500 shares of Paytm, which he bought at 900 apiece. He says he's a medium-term investor and he wants to know whether he should hold or sell. Let me come to you, Shaina, on this one. There have been some brokerages which, are turning positive on this, are feeling like, at current levels, it might be a good price to buy. But he has definitely got in at around 900. So what would you recommend?
There are a lot of positive developments that are coming out in Paytm as of now. Of course, valuations one cannot really talk about because they still have to move into profitability. But the issue is that they are talking of moving with being EBITDA positive by FY25, which is a good news. Also, if you see what they have given us some indication of the Q4 numbers. So in Q4, they're talking of an average monthly transacting users increasing by 27%. And here, I think most analysts are talking of this sustaining over the next 2 to 3 years. So I think these are positive developments, and one can look at to move or to exit at higher levels, probably keep a target of 750 or 800.
Okay, all right. A target of 750 to 800 rupees on 197 communication. Remember, there was a Motilal report which came out which was positive on it. We need to take a short break, but we'll answer more of your queries on the other side. Stay tuned.
The movie Three Idiots was the first time many Indian households got acquainted with the concept of drones. And prototype of the drone used in the movie was developed by a homegrown startup called IdeaForge. IdeaForge is now a pioneer in the Indian unmanned aircraft systems with a market share of nearly 50% in 2022. The company has nearly 20 patents registered. It has deals with Indian Armed Forces, state police forces, and organizations like DRDO. In April 2022, it backed $20 million in its Series B funding round from several investors, including Florentry, Infosys, and Exim Bank of India, among others.
India is getting excited about the flourishing drone industry as it aims to be the global drone hub by the end of the decade. These steps like liberalization of the drone rules, rationalization of the norms of the drone pilots, and establishment of the drone schools have given new direction to the industry. The recent allocation of rupees 120 crore under the PLI scheme in the recent union budget acted as a booster dose for the Indian manufacturers. Even just a few years ago, drones were considered a niche industry, but now investments are starting to pour in. Ankit Mehta, the CEO of IdeaForge, which was formed in 2007, has witnessed a complete transformation in government policies and investments throughout the years.
So I've in a way seen the drone regulations go from ignore to deny to accept to support. That whole cycle we have seen, right, from the very beginning, and absolutely.
Welcome back. Well, for the markets, it is turning out to be a largely consolidatory session. The negative is that the advanced decline ratio is on the declining side this afternoon. So we have around 1,500 stocks which are advancing, but over 2,000 stocks which are declining on the Bombay Stock Exchange. So there is some amount of trepidation on that. Just watch out for specific stocks on a week-to-date basis which have shown good moves. So case in point from the broader markets would be something like a Patel Engineering, which has gained around 20% on a week-to-date basis. The stock, which is currently trading at around 18 odd rupees, has seen good amount of traction both this month as well as this week. The other one would be something like a Titagarh Wagons as well from the railway space. That stock has picked up around 17% in terms of addition to its market cap on a week-to-date basis. The other one would be Nazara Technologies, which is up around 8% at this point in time. and it's gained, around 7.5% this week. Yes Bank, going into its numbers, is a bit weak. That stock is down around 1.8%. But we still have with us Ashish Kyal on the technical, Shaina Mukaddam on the fundamentals to answer all of your queries this afternoon. Well, let's get to another question then. We have a query from Bihar where SAS3 holds 92,000 shares of Yes Bank with an average of around 14.8 rupees. Long-term investor wants to know a 2 to 3 year prospect of the company. Shaina, I just wanted to get your thoughts on this, considering the kind of downtrend that we've seen in terms of the numbers for Yes Bank, the stock performance. Do you think it's bottomed out and the worst is behind the bank, and say 2 to 3 years down the line, this could possibly be a good buy in hindsight?
Well, actually, I would say at current levels, it would be, beneficial to continue to hold. There could be an upside. I think the decline that we saw was, of course, because, if you see in the first 9 months, the provisions were pretty high. And actually, that was what has impacted the profit number. Now, the growth should be quite steady and good in terms of operationally. I think deposit growth is estimated around 14% and odd. So I think numbers should be pretty decent on the operational level. And also, if you see the valuation at just one-time book, it is pretty attractive. So I would continue to hold, given the fact that now you have good institutional investors also that are part of the bank. So I would continue to hold at current levels. One will continue to have to watch, what sort of asset book quality they report over the weekend.
All right, so let's wait by and see how those earnings really come from Yes Bank. Ashish, technically, would you think that this one is okay to hold?
From technical perspective, over short term, yes, we saw some bounce back from around 15 odd levels. It went to 17 and now showing some consolidation or pullback on the downside. So once it manages to reverse back above that 17 level, we can expect it to go towards 18.5. So I would recommend to hold for short term. Over the long term, we have seen the stock going all the way to 24, then correcting back to 14. So if the investor is okay with such kind of volatility with a sharp up move and sharp down move, then it's okay. Otherwise, you can also diversify into something like SBI or possibly Kotak Bank. Those banks can be a much more promising returns than Yes Bank, but the volatility is also a concern for me. In Yes Bank, over short term, I am optimistic for it to reach around 18.50.
All right, that is the view coming in on Yes Bank. Is willing to hold for 2 to 3 years. So that is the view coming in. But with that, let's move on to our next query. This comes in from Krish, who writes to us from Pune. He says he has 500 shares of Wipro, which he bought at 400, and he's holding this since 2020. He's a long-term investor and he wants to know whether he should hold the stock or sell. Shaina, he is sitting on a bit of a loss, and the mood with tech is really, been a little bit divided. Of course, the big ones did disappoint, but some of the mid-cap IT names have been doing well. For Wipro, how do you think it's likely to fare?
Well, it's been, a disappointing large cap IT stock in line with, a lot of other IT stocks. But I think for Wipro, analysts are expecting a dip in revenues, and I expect that, the numbers are not going to be that exciting. So to an extent, everything is factored into the price. I don't see too much downside. At the same time, I don't see why one needs to continue to holding the stock. The performance is likely to be lackluster. So I would switch. There are a lot of other sectors that are doing pretty, are doing much better. So in my view, it would be a better idea to switch from Wipro to some of the other sectors like FMCG, ITC. You have ICICI Bank, which will report numbers. I think these are more, these are stocks that are likely to give better returns over the next 6 months to a year.
Okay, all right. Well, let's get to another question now. We have Karan, who writes to us from Chennai, holds 500 shares of Nestle, which was bought at an average price of around 200 rupees. Medium-term investor wants to know what to do, whether to hold or sell that particular stock. I think maybe there could be some amount of change in the buy price. But in any case, what would your call be, Shaina, with regards to Nestle? On a longer-term basis, would you possibly recommend holding on?
Absolutely, I agree with you, Ekta. The buy price seems like unbelievable. And if that is the buy price, then there is no reason to, even question whether one needs to continue to hold. Unless, of course, the investor wants to book his capital gains or, maybe diversify his portfolio. But at the same time, I would say that the return that one has got in the last 5 years, it's almost up, multiple times for such a large cap stock. I don't think that sort of return is likely over the next, say, 2 to 3 years, because simply because valuations are very high. If you look at turnover to market cap, it's about 10 times. You have your P ratio, which is in the 80s. So I don't think that sort of upside you can expect. At the same time, balance sheet is so strong, good management, good products. I mean, what more can you ask for?
Okay, that is the fundamental call on Nestle. Ashish?
Maybe the buy price was 20,000.
Yeah, I'm sure that doesn't sound quite all right over there. But Ashish, that said, how do you think this one looks on the technicals?
See, on the technical, we can see very smart recovery from 18,000 levels in Nestle over the period of 1 year. It has done exceptionally well. The overall sector FMCG has been outperforming, and I think Nestle can head towards the level of 22,000 as well on the upside. So continue to hold here. On the downside, the support is around 19,800. So keep that as a support or a stop loss for yourself, and expecting a target of 22,000.
Okay, target of 22,000 on Nestle. That stock has given returns of around 2% in the past 6 months odd. But let's get in another query. We have Rakesh, who writes to us from Delhi, holds 1450 shares of Vedanta and at 308 rupees, and 700 shares of Reliance India at 196. He's a long-term investor, wants to know what to do with both these counters. Well, Ashish, your call technically on Vedanta from the metal space and Reliance from the agri space.
See, if you look at the overall metal space, look at Vedanta or Tata Steel, Hindalco, all of these stocks are just consolidating or rather correcting over the period of last 1 to 2 months. We can clearly see that. But having said that, Vedanta has formed a very important low at around 260. It managed to bounce back every time it reaches there. And it's forming a triangle pattern with the possibility of a positive breakout. So I would suggest that continue to hold on to this stock with 260 as a stop loss and expecting a target of 320 on the upside once that 290 level gets broken out. So 320 can be the target and 260 is the stop loss on Vedanta over short term. And as far as Reliance India is concerned, yes, it has been a disappointing stock. Showed a very steep fall from 255 levels, went all the way towards 186, 187 on the downside. Showed some recovery from there. So I would hold on to this stock, but not expecting much from here. On the upside, possibly towards that 220 or 225, look forward to exit this stock. On the downside, maintain a stop loss of around 190 levels.
Okay, so that is on both of these, Vedanta as well as Reliance. Shaina, let me quickly come to you as well on what you think of these. I mean, metals, of course, have been moving to a lot of the global news flow as well, right? Do you think from a slightly longer term perspective, it's a good one to hold?
Well, I would say in the medium term, both look good. Vedanta as well as Rallies are holds. Rallies, of course, has been impacted because of higher raw material costs. And, rainfall, we don't know what sort of rainfall we are going to have this year, shortfall or a normal rainfall. So that would be a deciding factor on Rallies. But the stock price having corrected, I think strong management, strong balance sheet, one can hold. Now, Vedanta is a more difficult question. Things are looking better for the company now because they're bringing down the debt, and it's a very high dividend paying company. So anybody who is looking at high dividends, Vedanta is the stock for now. And of course, the rest, aluminium, oil, they're doing reasonably well as of now. So one can continue holding.
All right, got that. So that is on Vedanta and Reliance. And with that, Shahina, Ashish, we're going to thank you very much for joining us on the show today and taking out the time, as always, for speaking to our viewers and helping them with their queries. We leave the market absolutely flat. The Sensex has moved into the green, so that's the good news. Just around 10 points lower on the Nifty right now. Big move seen in ITC. That one continues to move higher. You have Reliance, which has seen a move upwards ahead of its results. And some other names like Bajaj Finance also seeing a jump in trade. But with that, we're going to wind down on this edition of Your Stocks from Ekta, me and the team. Thanks for tuning in. Remember, you can always email us your queries and we will take them up with our experts. Stay tuned. Closing bell is up next for the final hour of trade this week.
March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points. Now the market share is 17.4%, and for SBI, the loss is about 111 basis points, with market share being now at 17.9% on a YOY basis. So credit card issuances, SBI card has gained market share by 202 basis points YOY to about 19.65%. Axis Bank, due to Citi acquisition, has gained by 195 basis points to about 14.2%. ICICI Bank has seen a reduction of 175 basis points to about 16.95% now, and HDFC Bank has seen reduction of 190 basis points in the market share to about 20.56%. Top 4's market share in total cards has moved to about 71.06% that you had in March 2022 to right now about 71.4% in March 2023, a gain of 32 basis points, and that was largely for Axis Bank due to the Citi acquisition. Outlook on credit card issuances is that it remains strong in terms of, the credit card distribution. On expected line, spends have increased due to summer holidays. You need to watch out for the revolver rates, which are on a declining trend for the entire sector. Now, many private lenders are still going out with huge offers on credit card to their customers, so that needs to be seen how that will move ahead. Holiday season could keep the spends on the healthier side. You need to watch out for the inflation if that impacts on the spends of credit card, if any.
Apple is the world's largest company by market capitalization, with a market cap of $2.6 trillion. At its peak in January of 2022, its market cap was in excess of $3 trillion. It became the first company to reach $3 trillion of market value, which was more than the GDP of India, UK and France. Even today, with a market cap of $2.6 trillion, it's more than the GDP of Canada, Italy, South Korea, Russia, Brazil and so many other countries. Some more stats. The Apple stock price is up 300% in the last 5 years. More than 2 billion people worldwide use Apple products. The cash in the books is close to $50 billion. Not just that, it's one of the most profitable companies in the world. According to Statista, it's the second most profitable company in the world. Now, Apple's been a game changer in almost every segment it entered into, transforming music streaming with the iPod in 2001, taking the smartphone market by storm in 2007, and the wearables market with Apple Watch. So let's understand how Apple generates its revenues. Now, 50% of Apple's sales coming from iPhone, a majority of it. Mac and wearables contribute 10% each. iPad about 7%, and services is a growing stream and is now almost at the 20% market share. Since the iPhone contributes a majority to its revenue and is its mainstay, let's understand how it compares with the market leader. The market leader by volumes is...
Most of Asia is in the red right now.
It's a largely inline set of HCL technology, but in such a macro environment, uncertain environment, no negative news is actually good news and is a positive surprise.
Look at the rally that we've seen in global stock markets, especially US. That has been driven by PE expansion. If you look at earnings expectations, they have contracted from around plus 5% at start of the year to around flat right now.
We expect FY24 to be a very strong year for financial services.
Nifty absolutely quiet, just about 15 points in the green.
Macro is the bigger challenge, not only for India, I think more globally than India.
Obvious risks in areas like semiconductors where there is a slowdown that is anticipated.
I do believe that we can grow the savings line of business in line with the nominal GDP growth rate of the country.
I have not understood what the logic is for a cap on two-wheeler pricing, for example, to be 1.5 lakhs of rupees, because that is the bone of contention as I understand it.
Oil to chemicals business, which is a key reason for the recovery this quarter. There's a sequential recovery that we're expecting for a couple of reasons. A stronger base gross refining margins and lower windfall tax is something that can aid this segment for them.
As far as the Nifty is concerned, down to around 40 odd points.
Well, the last 1 hour of the week, back from the brink, breaking the Monday low, then recovering. It's all happening right here. You're with us on Closing Bell. I'm Surabhi Upadhyay and Nigel D'Souza and Mangalam Malu with me in the house today. Hi, guys.
Well, good afternoon, guys. Just an hour or so and then we're off for the weekend, but it's going to be a busy one. Reliance Industries today, ICICI Bank tomorrow. But just take a look at the markets. Easy peasy, having a snooze fest, right? Markets have not moved too much. It seems that we're bracing for a bit of a time-wise correction, right? Just going by it. And maybe one could argue there are enough triggers to even halt the market. Why should it go to that fresh all-time highs? Are the triggers in place? We need a blockbuster number coming in, say from a Reliance Industries. Coupled with that, maybe the IT index stabilizes. And then, in fact, you have ICICI Bank to fire up the Nifty Bank as well. Otherwise, it's going to be rather hard, I think, to go up because the flows as well are drying up a little bit. That's the FI big flows that we have been seeing in there. I'm looking at the options data and the broad band that it suggests is the 17,500 on the downside. If you want to play the range, then maybe you have to buy closer to around 17,500, 17,550. Risk reward is favorable out there. But at higher levels, 17,750 around 17,800, maybe in fact we face some bit of resistance. And just take a look at the options data, 17,700 call. Well, out there, the open interest again has seen a big upswing, close to around 70 lakh shares getting added over there. And take a look at the total open interest. It's going towards that 2 crore shares already. Yesterday as well, we saw a fair bit of open interest build up, but towards the end, because it was expiry, there was some unwinding out there. Now, this is a fresh contract that we're talking about. So just keep an eye out on that strike. These call writers, they're bracing for the 17,770 odd level, not breaking. So that's the positioning. But on the downside, the 17,600 put as well is seeing a fair bit of open interest build up. And out there, close to around 45 lakh shares are getting added. Now, these put writers, they're looking at around the 17,570 odd level holding out. How do you get that number? 17,600 put if you're writing it. You're pocketing close to around 70 rupees. So you deduct that from the strike, which is 17,600. Guys, let's hope for some fireworks in the final 60 minutes odd. Otherwise, it's really been lackluster.
You know, I really thought that when the market started making a move for the downside, not for the sake that I'm siding with the bears, I really thought we're getting maybe the sign of some directional moves because we did break the Monday low. But then it's a recovery back. It seems like we're stuck to 17,600 for now.
17,600. You know, I was just looking at some of the numbers. Just last 3 days, we've been tracking the markets, talking about how flat, lackluster it has been. It's there in the numbers. You know, the highs on April 19th, 17,666. The high on April 20th was 17,684. The high today, 17,663.
Yeah.
Virtually unmoved. The lows, up until the Nifty fell in late afternoon, the lows were also pretty much similar. 17,589 was the low. Then it fell all the way to 17,554. But 17,580 day before yesterday was 17,584, and today 17,554. You look at the range as well. The market hasn't moved much. 156 points 4 days ago. Yesterday was close to around 100 points. The previous day was 86 points, and today as well, despite the big dip that we saw, just 109 points. So that's a magic God-given opportunity for all those who are writing options to pocket that premium. The only thing that really stands out for me today, despite the underperformance of the mid-cap index, is that the Nifty, for the second or the third time in a row, has defended that 200-day moving average. Today as well, it briefly fell below that. There was a scare of almost 40 points below that, 17,554. It's recovered right back up and holding on to those levels. So that is something I'll be watching out for.
Since the levels aren't making us any wiser, I'm just going to look at stocks right now. Let's pull up first to start off with the Nifty contribution plate. And it beautifully showcases how things are completely netting each other off. So you have a TCS on the upside, you have an ITC on the upside, and then you have an ICICI Bank on the downside. You have a stock like an L&T on the downside. So it's an absolute perfect netting off. Reliance has moved to the green side of the screen now, but that's not really moving the needle on the index too much. But those two big stocks are obviously in focus ahead of earnings, both Reliance as well as ICICI Bank. Just want to pick out some of the mid-cap names, because today what's happening is that the mid-cap index is actually down. Yesterday, the mid-cap index was flat. There was a lot of buying in individual stocks. Today, at the index level, this index has been down right from the morning, and it's been underperforming the Nifty. Pull up the advanced decline ratio, and that's something that's changed. Last 4 days of this week, we were talking about a very good market breadth favoring the advances. Today is slightly different. Today, it's been the red line dominating the green right from the morning. I'll pick up some stocks that caught my eye. Some of them, are just moving on their own price and volume momentum, and these are the ones that I'm talking about. Nazara is having a great session today. Its high, I think, was 8.5%. Zomato is up. Delivery is doing better. So there's individual stock buying, and then there are the stocks moving on news. Cyient, for instance, another good number from the mid-cap IT space. Vodafone Idea with Mr. Birla returning to the board. Oberoi Realty is a little curious. I mean, the update looked okay, the fourth quarter update, but maybe there's some profit taking happening, down about 4.5% on that stock. But it's all about, I think, individual stocks.
Well, that's right. The problem is, at least, otherwise, if the market has to go through a sidewise correction, you're okay, time-wise correction. But you want those mid-caps to continue the party because they started off this fiscal year in style. Well, plenty to talk about. First up, just take a look at the bottom of your screen. I had a chat with Mr. Anil Agarwal, and, he said that all the payments due at the parent level will be made, and it seems they're moving in that direction. Vedanta Resources says that it will make the bond payments due later this month. So good news coming in there, but it's not something surprising, because for the last couple of months or so, last 45 days or so, we have been reporting it on the channel, and Mr. Anil Agarwal as well has been quite vocal that he's going to be making all those payments that are due. But what happens from here on is going to be crucial.
But Nigel, also, since we're talking about this, and who better than you to just put this in perspective? It caught my eye yesterday. They're increasing pledges against Hindustan Zinc, right? They're again raising money by pledging more of Hinzinc shares. So obviously the parent entity's cash needs continue.
So I'll tell you what, Surbhi, yet again, in that interview which we had with him, I'd put this question that why are you pledging so much of your shares? And he explained to me that some of this is not pledge against shares. It's you take a loan and this is a top up. So it doesn't mean that if the stock price falls, it impacts, the pledge gets impacted. It's a top up on top of that. So it's not a direct share pledge is what he explained to us, at least at that point of time. But that's correct, what you're saying, because that one deal that they proposed of Hindustan Zinc going ahead and buying Vedanta's international zinc assets, that's on hold as of now, and it's unlikely to go through. We'll be speaking to the management later today in the next couple of days or so. And on Monday, hopefully, we get some clarity on that front as well. But that's about Vedanta and Vedanta Resources. How do you position yourself, though, in the final hour of trade? Mitesh Thakkar joins us to tell us exactly that with some closing strategies. Mitesh, what do we say? We speak twice a day. And, we are in this 30-40 point range. Do you trade the index or just avoid the index from now? And let's focus on individual stocks. What's your take?
So on the index, we've been saying this, and while the idea is to buy on declines and 17,550 held by a whisker today, I think the overall setup still suggests that it is a sideways consolidation. So 17,550 is held on. I think we've got a bounce back from there. And I still believe that, if that level doesn't break, maybe another 2-3 more days are left for this consolidation till the, the hourly and the 2-hourly indicators, which were extremely overbought with that rally from 16,850 to about 17,850. I think those indicators will come to again, neutral or maybe, slightly undersold levels. So that will, then should provide space on the upside for the next leg of rally to play out. So I think maybe 1-2 days more is what I'm expecting as we approach the expiry next. If we don't break 17,550, then I think, we should prepare for a very strong move on the upside. It's a contracting market, so typically after contraction, the expansion phase should come. Having said that, I have buys on Asian Paints and Pidilites. Both are crude-related stocks. Asian Paints, if you look at the chart, had corrected a lot. I think now it's getting into some kind of a reversal zone. So buy here with the stop at about 28.55 for targets of 29.40. And Pidilite is something which is also made a fresh swing high today. That's a buy with a stop at about 24.20 for targets of 24.90.
It's interesting that you picked both Asian Paints as well as Pidilite from the FMCG space and didn't speak about ITC yet. It's at a fresh all-time high, perhaps an expansion phase coming in for that one as well. Mitesh, 408 on ITC, the biggest contributor to the Nifty in the last 1 year or so.
So I think that's, very possible that there's some kind of as you rightly said, expansion happening in the charts of ITC. In fact, I gave a buy call today. The stock has been going through a very steady up move. It goes up, makes a new base, and then, again starts moving up. So this is a phase when the market has again, after making that base or the consolidation, which was mildly rising between levels of around 395 on the upside to about 375 on the downside. And then we saw a breakout on the 17th of April. Then 2 days of sideways pullback and then again, pick up on the momentum. So the expansion is going on. I think 415 was the trading target, but I think the stock is heading towards 425, 430 zones.
Well, thanks a lot for that. Mitesh, we'll touch base with you later on the show. Thanks so much for joining in and, filling us in with your take on the index, as well as a couple of stocks. Manglam, just take a look at delivery. I don't know what's going on here, but, in a dull market, that's delivering for the bulls at least,
Have taken place on delivery itself. Nigel, yesterday there was an update that came in on the exchanges that Abhi Kumar Mitra has moved on from the company. Abhi Kumar Mitra was part of delivery or was incorporated into delivery as he was the previous CEO of SpotOn. The biggest overhang on the stock was the delay in integration with SpotOn, the company that they acquired.
Yeah.
Now the press release says that Abhi Kumar has moved on post the successful integration of SpotOn.
Oh, very good.
So now that he's moved on, it means that the integration with SpotOn has been successful. So that overhang is out of the way. That is one. Secondly, over the last 3 or 4 trading sessions, if you notice, we've seen a lot of initiating coverages coming in on these new age companies. Motilal Oswal's written on Paytm, on Zomato. Bernstein has written on delivery. They have a target price of 360. They said that the company's taken a lot of corrective actions in the past few months that will drive earnings recovery. But importantly, we need to watch out for the long queue of PE exits. That may keep, the stock price in check. So those are a bunch of things we'll be watching out for. But for now, the street believes that the company's corrective actions and the fact that there has been a successful integration of SpotOn, then it's spot on.
Okay. You punned on it before I could. All right. Well, let's ask Prakash what his thoughts are. Prakash, good afternoon and happy Friday to you. You'll find us sounding a little more cheerful than usual for obvious reasons. Let's start with some of these new age companies. Your thoughts on what Manglam said, delivery, even the others, Paytm, Zomato. A lot of those stocks are actually doing well today.
Good afternoon, Surbi. Yeah, and happy Friday to you as well. So, yeah, I think we've spoken about delivery some time back. Nigel and I had a chat on this when it was under severe pressure. And that was all thanks to those overloaded exits that were the PE exits that Manglam alluded to. Those were always weighing heavily on the stock from a technical overhang perspective. But from the fundamental business side, SpotOn is, of course, a great acquisition. Makes a lot of meaningful, sense in terms of synergies, and they'll be able to, make it accretive very quickly. But what's interesting is that space has had a decimation of the weaker players, and that gives the likes of delivery a lot of pricing power when things start looking up. It's going to be extremely difficult for people to make a comeback. The ones who have not been able to survive, who have scaled down, were critically, impaired. And that's where the space actually loses a lot of the weaklings and the stronger ones survive. Deliveries managed to do that. At some point, the unit economics will start reflecting very favorably. And I've been talking about this at the current levels, or probably even at closer to 380 when we spoke. It's something which has offered a decent risk reward if you are a long-term player. But remember one thing: the new age businesses are very difficult to evaluate on the conventional revenue stream basis. It's more of the opportunity size and how soon you could kind of start leveraging on that. And that goes for Zomato and the Paytms of the world. But Zomato has probably got its pricing right, has started seeing acceptance of passing on those costs to the consumer, and rather than haggle with the restaurant players. So that shift has been very gradual, very quiet, very subtle, but it will start reflecting in unit economics as well. So that's where probably people are counting on. But all of it's going to be in good time. There's nothing tearing her. Yeah.
Right. Prakash, the only non-performing new age stock right now is Nykaa, which is currently hit a fresh low. It's down over 60% from its post-listing highs as well. So we'll watch out for how that pans out. Of course, a bunch of other problems happening with Nykaa as well. We'll come back to you in just a bit, but important flashes at the bottom of the screen.
Yes, absolutely. And this is, of course, exclusive information that our colleagues are picking up. And this seems very, very interesting. We know that there has been a lot of back and forth and a lot of tossing of ideas around what to do with TERs, total expense ratio of funds. And it seems now, what we are picking up from sources is that SEBI is looking at an entirely new category of performance-based charges. Right now, whatever we pay as the expense ratio on a fund, it has no bearing on the fund manager's performance. But it seems that this is a new concept that SEBI is toying with. Right now in discussion stages, we will actually get on this story in just a bit with our colleagues. Could be a very, very interesting one and an absolute, first of its kind idea in the Indian mutual fund landscape. But while we wait to get more inputs on mutual funds, let's look at life insurers, because a lot of the life insurer stocks are actually pressure, whether you pick up an SBI Life, HDFC Life, ICICI Pru. So what's troubling them? Of course, we know that the last quarter was good because you had that big push on the 5 lakh plus premium policies. But what lies ahead? Let's ask Surbhi Sutaria, who has the details. Surbhi?
As we've been pointing out, that the life insurance monthly data for the month of March is extremely strong, but the stock prices are giving us a different picture. All life insurance companies are trending downwards in today's trading session, and a couple of reasons for that could be: one, this growth is being driven by the increase in the average ticket size of policies and not by the number of policies being sold. And two, this accelerated growth could impact the numbers for FY24 now, as the growth will be on a higher base. Now, all brokerages also have a similar view, but they still are positive on this life insurance space. HSBC says that they have cut down their FY24 APE estimates by 600 basis points. Kotak says Q4 FY23 was higher than their estimates, translating into a higher base, but they will wait for all companies to report their numbers before they revise their FY24 estimates. MK expects a flattish kind of APE growth for FY24. And lastly, Investec says that the budget proposals will impact the value proposition in the high-ticket segment, but according to their estimates, it is only 10 to 12% of the VNB for all life insurance companies. They're all positive for this space, but APE growth for FY24 still remains a concern.
All right, APE growth for FY24 still remains a concern, and that's why perhaps all the insurance stocks are under pressure. Is that perhaps the reason why even, luxury realty stocks are under pressure as well, despite reporting a good number for the fourth quarter? Overall realty is down about 4% as well. Prakash, your thoughts on both the life insurance space and the real estate space, mainly because a large part of demand took place in the previous quarter because the tax breaks are going to go away.
Yeah. So I think it's a bit irrational to believe that just because there's a higher base, thanks to the lumpiness in the March, month of March, when that advantage was getting over, that you would have on a year-on-year basis slow growth. I think it's a fallacy. The whole idea is that life insurance is a very secular uptrend. I mean, look at numbers from HDFC Life, Mangalam. It tells you exactly that it's not just a March phenomena or a tax break, or a regulatory cutoff phenomena. It's more to do with acceptance, and the more technology comes into play, my sense is VNB is going to be, the VNB parameters are going to look very different in the next couple of years onwards. So wait for that. There is a level of digitization that's started a bit late in life insurance, given its complexities, and especially the documentation involved, as compared to, let's say, plain investments. And that's where, you know, I think I see higher acceptance. So I'm quite positive on the space, but there's a basket approach that you always take. And some of the bond portfolio, you know, the investments in bonds that LIC has got, they probably are not getting valued at the same level as what you would, you know, have in terms of, you know, what the MTM impact would probably be favorable for them as well. And that's going to start reflecting at some point in time in their portfolio. So all those things will kind of set things right. But yeah, very, very positive on the life insurance space. On reality, I just want to tell you, I think it's just a little bit of profit booking that's come in, given that monsoon will probably slow down things and, you know, the general expectation seasonally, but it's in a great spot. The kind of demand, especially for premium segment. Overall reality, the numbers were fine. I think it's just profit booking because their projects are doing well. The offtake is positive. There's no contraction in demand in at least the luxury housing segment. So people who have very clear identified assets being built up there and an inventory build up there will benefit. Focus on pockets like the NCR or maybe Delhi. You know, those are areas where there is still a lot of pent-up demand and very less supply, unlike Bangalore and Hyderabad and things like that. So I think you can choose a lot saliently, but real estate is definitely something you should look at in your portfolio for sure.
Okay, all right, got that. Thanks for those inputs. Stay on, Prakash. We'll come back with some more questions. Quick break right now. We'll also be chatting with our alpha manager of the day, Trideep Bhattacharya of Edelweiss AMC joins in.
So fortunate, almost all of us, that we have no idea what it is like to be on the front line in a war facing bullets and missiles and rockets. What is it like? Do let's hear from a soldier who was there, who was fortunate enough to have returned alive, even if he lost a leg. Life as a soldier is never easy, but those were happy days for Nikolai Lukash with his buddies on the front lines before the war hit. The war is still here, and so is the trauma for those who have seen the worst of it. I was posted close to Mykolaiv. I was in the Marines. Then we were posted to Mariupol to replace the 128th Infantry Brigade. The invasion we were expecting came on February 24th. The Russians broke into Mariupol and surrounded us. Their ring around us became closer and closer. Then they began to bomb us. Everything around us was destroyed. We ran out of ammunition, food, water. There was nothing left. We put up white flags over our bunkers, and still the Russians kept bombing us, hitting us with the rockets. Thousands and thousands of soldiers and civilians were killed. We kept trying to fight the advancing Chechens from the Russian side. We tried to evacuate, but we had been surrounded. I was hit by a shell. I was taken prisoner.
Welcome back. Markets as flat as can be, but we have some news that's flashing for you on the screen, and that could be a sentiment negative for stocks like Dixon Technologies, because the Karnataka High Court has rejected Xiaomi's petition challenging seizure of around 5,500 crores by ED. Remember, as a sentiment negative, it could impact Dixon. But Dixon, as Manglam was just telling us in the break, that in the past they've said they're not a very, very big client. But as a sentiment, it could hit them. And that's why we're seeing the stock react. Remember, it saw a bit of a bounce from the recent lows. But now, in fact, on the back of this new space, it's moving a little bit lower. Prakash, what's your view on Dixon? There are a lot of triggers in store. The problem is they haven't achieved guidance in the past. FY23, they've kept scaling back. And this sort of issue is a bit of an overhang. Your view?
So honestly, if you look at structurally where it's positioned, Nigel, the history, the glorious past that it has had when it started off scaling up and when PLI was introduced, that's going against it because the expectations are so high that anything that's short of those high expectations starts kind of sounding negative. What they're doing is a great job. There's no denying that. But we've seen stretched valuations. So there's been PE contraction thereon. Then we've seen EPS reductions and expectations of some sort of a lumpiness in the EPS towards the second half of FY24. So all of that expectation probably makes it to be a little bit of a soft counter. I mean, it might not go through a very deep price correction, but it could go through a time correction till things look up and catch up and expectations get kind of calibrated. And this news that you kind of talked about, it is negative for sure, because if it's not going to get stayed, that means there's going to be much more damage that can happen and percolate to the P&L as well from the client. So, that's definitely a negative, and that's why the markets will be reacting to that. But I think you could give it some time to kind of consolidate and settle down and look at where the EPS moves or what pace it moves before you take a call on it.
That point, although the management on its part multiple times have joined us and said that issues like this will not impact any of their receivables or the deals that they have with them already. So we'll have to watch out for how this pans out. As of now, looks like it's a bit of a sentiment negative. But I wanted to know your thoughts on the footwear space, Prakash, because that's been on the run over the last few trading sessions. If you just look at it, something like a Mirza International up 10% locked in upper circuit right now, and it's not the big front foot players, it's the back foot players which are now catching up. We have names like Liberty Shoes without any rhyme or reason up around 35-40% this month. But now the big boy is catching up. We have Bata, which is moving higher and has moved to the high point of trade. Because of Bata's underperformance over the last 1 year or so, its valuations have become a lot more palatable as compared to some of these other listed players like Campus, Metro, etc. Would you take a look at Bata right now?
No, I've always liked the company. What they've done to reinvent themselves has taken much longer. They'd articulated a vision which was towards 2025, which probably seems like a bit difficult, a bit challenging to achieve in terms of some of the store metrics and some of the product lines that they wanted to launch and the price points that they want to kind of move up to. So what's important is you rightly mentioned, look at Mirza. I mean, Mirza is a titan of footwear. It doesn't need to sell too much. What it sells is of value. It gets them great margins, and it always keeps on selling better, right? So that segment keeps on growing. It's not impacted like the Khadims or the Liberties of the world. But what's happened is some of these footwear companies like Campus and all, which have a different range or probably a much more narrower range, have actually got too much of premium thanks to the history of Relaxo and all those other names that we've seen in the past. So that has helped them achieve PE expansion, Mangalam. But if you look at Bata, you really get value. You get a very veritable, solid business, underlying business within the footwear space, which is irreplaceable in that sense. But what's impacting them or what's been ailing them is the fact that they've not been able to leverage on all that in terms of revenue growth and margin growth. But that seems to be probably happening as they get closer to that vision that they'd articulated. But I would definitely love to look at it if there's any trigger that there is an improvement which is probably more secular than just a flash in the pan.
We'll figure out how long this flash lasts. Last couple of days at least, 2-3 sessions. Footwear has been quite, in step for the bulls. Well, Prakash, we will leave you to now enjoy the rest of your evening and your weekend and touch base again next week. Have a good one.
You too. Thanks.
Okay, well, lots to talk about with our next guest as well. Tridib Bhattacharya is joining in. He's, of course, CIO at Edelweiss. So we will get to Tridib. I think, we have him with us. Yes, so we do. Tridib, great to have you on. Thanks for joining in. I was just taking a look at some of the, portfolio holdings. Mangalam and Nigel were telling us about some of your, big holdings, both on large cap and the mid cap fund. Banks definitely make it to your top list, right? And the big boys, HDFC Bank, ICICI Bank. So I want to ask you this, that incrementally from here on, are you still expecting big moves in banking? Because banks have flattened out in 2023 after a stellar 2022. Would you expect bigger gains in the rest of the year?
I think overall banks are probably one of the sectors where on valuations are in our favor. While in other cases, valuations are at average. In certain stocks, in the case of some of them that you named, the valuations are still lower than about 5-10 year average. So valuation case is in our favor, number one. Number two, in many ways, fundamentally, they are in a very sweet spot. So they've gone through an NPA cycle, the balance sheet is clean, there is credit growth that is happening in the economy, and them will benefit from that. But that probably people know. What we will see over the next year or so is basically as some of these provisions reverse and some of a good amount of profitability or a lower provisions leading to earnings growth, which will probably stack up quite well when you compare with other sectors which are there or thereabouts. So I'm very confident that on a relative basis, banks will for sure do quite well over the next year or so. In absolute terms, we have to see where the stocks really trade versus their valuations and take a call accordingly. But you're absolutely right. We are positive on lending financials, if I may call it that way, across our multiple portfolios that we do so, because we think we are at that stage of the economic cycle where credit growth is picking up, loan loss provisions are at low, and fortunately, we don't have some of the excesses like what we see in some of the other geographies.
All right. Hi, Trideep. Good afternoon. Trideep, I wanted to ask you, banks, they expected to outperform. The street is betting on that. But IT, the street is split on that. So I want your view. But before that, let's hear out what the Cyient management had to say earlier today. Remember, those numbers were quite good. And now they're talking about achieving that revenue run rate of $1 billion by the fourth quarter of this year. We'll hear him out and we'll come back to Trideep.
We've taken into account some degree of macro uncertainty, which we all can't escape. But taking into account some degree of macro uncertainty, we're still quite confident that we have a run rate towards that number essentially in Q4 of this financial year. There is still a lot of work to do, but we believe, will we be there? Surely thereabouts, but we're working hard towards getting there. So that's still a line of sight. There are some obvious risks in areas like semiconductors where there is a slowdown that is anticipated. But I would say, I think now we have a well-diversified portfolio. If you look at the 4 reporting sectors that we have, which is transportation, sustainability, connectivity, and new growth areas, they're all very balanced. I mean, they're all, a fourth each of the services business. Or if you add the manufacturing business, that's also about the same scale. So these 5 pillars that we have, I think are working out very well. And let's face it, right? There were times when some of the sectors that we were in did not perform very well compared to the others in the market. And I'm referring to the aerospace sector here particularly. But now that sector has come back quite strongly. So I think we've positioned ourselves quite well.
Well, Trideep, Cyient management says they have positioned themselves quite well. What about you? How have you positioned yourself? I'm looking at your portfolio. You have Infosys, you have Persistent in there as well as a couple of those IT names among others. But your view on the IT pack right now, and also last couple of days, Mastech delivered a good set, your Cyient did deliver a good set, but the larger names disappointed. So how are you positioning yourself on IT on the whole, and within that, between large and mid caps?
Yep. So I think it's a great question overall. So we actually went underweight IT around about beginning of last year. And that has worked out over a period of time quite well for us. What has happened is that over a period of time, over the last 3-6 months, we have covered our underweight. And at the moment, we would be probably marginally underweight, stroke neutral in our portfolios. The reason why we are not overweight is, now, of course, it's out in public, that we always thought that this result season, the earnings estimates need to get calibrated for FY24 versus how may actually turn out to be. And Infosys did that. We saw TCS also talk about the same. That is being done, or that has been done so already, and the stocks have taken one knock down. Now, beyond that, it's basically how the individual companies are positioned with regards to discretionary spend in the United States, banking and financial services sector, and also the exposure to US. So the companies which are relatively low indexed in these areas are the ones which selectively would do better than others in the context of the sector, given that the macro growth rates have been set by the biggies. So that's why some of the individual mid caps or small caps, as they reported and as they will report, you will see these nuances play out over the rest of the result season in the context of IT. So sector-wide, we are probably neutral. stock specifics would do the talking from here with regards to IT in the very short term. But somewhere in the next 1 or 2 quarters, we think that the sector will probably bottom out, and it will be good to add even to on a broad-based basis and probably go overweight at some point in future, subject to evaluation.
Right, from IT we move to ITC, the big index heavyweight among your top holdings, done extremely well for you all. Just wanted to know what's the runway you foresee for this one in the consumer space. And the second one is Reliance, again a big overweight for you all, the second largest in your large cap fund. Reporting numbers today, what is it that you'd like to see in your numbers, for you to continue to hold your conviction here?
So ITC has been a meaningful long-term overweight for us across portfolios. And we've always thought that in the context of the consumption sector, which is reeling under the pressure of inflation, this is one spot where, historically we have kind of put our bets on, and that has worked out well for us in the past. We think that overall, the cigarette side of the consumption would probably see good amount of volume growth overall, and that will and that has helped us. Of course, going forward, we will see how that space pans out, but that continues to be a meaningful bet on us. With regards to Reliance, while the absolute weight is on the higher side, but I think on a relative basis versus that of benchmark, we would probably be underweight. We think that the earnings would probably be middle of the road, where while we can't talk stock specific numbers here, we think that overall will be just about versus that of expectations there and thereabout. I think what we would look to here would certainly be the progress on the retail side and on the new initiatives, what they plan to do, which will probably be more valuation trigger. On the renewable side would be the areas that we would kind of look to understand, apart from the core business, which I think broadly people anticipate.
All right. Trideep, just request you to hold on to that thought. The Hindustan Zinc numbers are flashing for you on the screen. And as we know, the holding between the Government of India, Vedanta, as well as LIC is nearly 97%. So very limited float in the market. But just to analyze those numbers, top line is more or less in line. The margin is a little bit better. And that's because the zinc cost of production without royalty, that's come down by close to around 6% on a sequential basis. So you're bracing for a bit of cooling off. And I think 5 to around 6% was the expectation. So it's cooled off by that much. That's why the margins are a little bit better than that. But more importantly, we know mostly what's happened in the past quarter. You want to know what's the view from here on. And they've given their guidance numbers as well. And they're factoring in a mild growth on the mine metal production. If you look at it, they're estimating that between around 175 to around 101,000 odd, which is a little bit higher than what they've done in the past year. But the good news is they're expecting the zinc cost of production to come down. So just to give you a number, in the last quarter, that's in Q4, it's at around $1,214 per ton. Now they're estimating in the coming year, it'll fall by at least $40 to around $100. So the band they've given of cost of production is around $1,125 to around $1,175 per ton. So that's the cost factor that's playing out. But we'll have to wait for the management commentary, what's happening with regard to the divestment, what's happening with regard to their plans on the international zinc business as well. Not a big mover on numbers where there's no float in the market, but just thought we'll analyze that. On the margin, a little bit better, but nothing really to take home with regard to this.
But good to have that perspective on the numbers, and on the slight, you can call it maybe slight beat on the margins and the EBITDA front. Market, by the way, is back in the green. So Nifty has managed to claw its way back on the other side. Some of the gainers, ITC, TCS, HCL Tech is positive now, 1.2% higher on HCL Tech as well. Infosys is up. So there's some incremental buying on IT and on a few consumer stocks as well. That's the story. Actually, even Wipro is higher, HCL Tech. Most of the IT big names are on the upside. Well, we do have to take a break, and we would also thank Trideep on that note. Trideep, great to have you on the show as always. We look forward to our next conversation. You have a good weekend. Well, we get into, thank you very much. We get into that break, but as we do that, let's get you a big voice from the auto sector. Of course, there's been a lot of chatter about whether the Indian government will perhaps not extend the EV subsidy scheme, the FAME scheme that is beyond beyond March 2024. Final decision, of course, has not yet been taken. Earlier in the day, we caught up with Rajiv Bajaj, MD of Bajaj Auto, to get his view on this matter.
I have not understood what the logic is for a cap on two-wheeler pricing, for example, to be 1.5 lakhs of rupees, because that is the bone of contention as I understand it. I mean, today you can buy a 20 lakh car and get a 2 lakh FAME subsidy on that, and that's absolutely fine. But I cannot buy a 20 lakh motorcycle and get a 2 lakh subsidy on it. Why? 50,000-60,000 is of course not small for any consumer. In the last 3 years, the prices of two-wheelers have gone up by about that much, as you know, for various reasons. And you've seen how that has impacted demand. I am not a fan of subsidies of any kind. And I do not think India is going to build a EV future based on subsidies. Subsidies going away, in my view, should not really have that big an impact in the long run, because the future of EVs in India will be built on the back of sound strategy, not subsidy. Subsidy is not a strategy, and in my view, subsidy disrupts strategy, subsidy masks reality, and subsidy blunts innovation.
We are so fortunate, almost all of us, that we have no idea what it is like to be on the front line in a war facing bullets and missiles and rockets. What is it like? Let's hear from a soldier who was there, who was fortunate enough to have returned alive, even if he lost a leg. Life as a soldier is never easy, but those were happy days for Mykolaiv Lukash with his buddies on the front lines before the war hit. The war is still here, and so is the trauma for those who have seen the worst of it. I was posted close to Mykolaiv. I was in the Marines. Then we were posted to Mariupol to replace the 128th Infantry Brigade. The invasion we were expecting came on February the 24th. The Russians broke into Mariupol and surrounded us. The ring around us became closer and closer. Then they began to bomb us. Everything around us was destroyed. We ran out of ammunition, food, water. There was nothing left. We put up white flags over our bunkers, and still the Russians kept bombing us, hitting us with the rockets. Thousands and thousands of soldiers and civilians were killed. We kept trying to fight the advancing Chechens.
Welcome back. The frontline indices virtually unmoved, but a lot of mid-caps currently at the low point of trade. We have Chennai Petro at the low point. Alongside that, Vadilal Industries at the low point. And Rajratan Wire, ever since it reported its numbers, where the profits fell by about 45%, the sales also fell by about 11%. We've seen a big dip on that stock. So Rajratan Wire comes up for you with a cut of almost 7%. But time now for our favorite D-Street Chatter segment, where Nimesh gets us an insight into the dealing room. Nimesh, for the last 3 trading sessions, we've been speaking at this time, and nothing virtually has happened at the frontline end of things. But mid-cap's not doing too well today.
Well, I mean, today you can call it as a dull day, because the Nifty is flat, mid-caps have underperformed, and even the flows are quite muted, is what I understand. So not much happening even in the dealing rooms. I guess, maybe a bit of a weekend factor as well that's playing out in the broader markets. I guess from a directional point of view, the two large heavyweight earnings, which is Reliance today evening and ICICI Bank over the weekend, will be very important, and that will mean a gap up or a gap down for the Indian market. So that's something to track as far as earnings are concerned. There are a lot of sectors which are under pressure today. You call it insurance companies; those are down. Metal names. Even the cement companies are seeing a bit of profit booking. The only sector which has seen a bit of a relief rally is technology names. Now, even within technology, the feedback is lack of selling than genuine buying interest, which is back. So again, looks like more of a short covering and a lack of selling kind of a relief rally in the technology names. So that's the overall feedback. Again, as I said, a bit of profit booking in the broader market as well, maybe because of the Friday phenomena, but nothing much is happening, whether it's broader markets or whether from a flow point of view. So relatively a dull day from a markets point of view.
It's been a dull day, a dull week as well, I guess, Nimesh. We've been searching for direction, totally range bound, right? But there's a lot of stock news and stock movement. So tell us anything exciting you're hearing today?
Well, it's a difficult day to find out, so to call chatters, but still I've managed a few of them. So the first one is Zomato. That stock is buzzing in trade. There was a block as well, close to 30 lakh shares, so the disclosures would be important. But beyond that, I guess the bigger thing is there is a hope or a buzz of a very large block deal coming very soon in Zomato. So that's something to track as far as Zomato is concerned. Again, remember, for every now and then the strategic investors, including the Chinese investors, keep selling. So that's something to track as far as Zomato is concerned. The second stock is PI Industries. While it's buzzing in today's trade, this week the stock is up 5% in a dull market. And again, the big indication is that maybe the company is very close to an overseas acquisition. Remember, for a very long time, it's a speculation that they want to get into the pharma business. So that's something to track in PI Industries. The third stock is Ujjivan. Not much in terms of news, but purely buzzing on back of strong flows at NFI. So the delivery volumes are expected to be quite high in Ujjivan today. And the last stock is Bharti Airtel. Within the large cap, this is one stock which is seeing some bit of selling pressure back, and looks like some long only funds are active sellers. So that stock is not too much under pressure, but the flows are on the sell side.
Right, Nimesh. Thanks a lot for that. In fact, trust you to extract some juice out of the grapevine of the dealing rooms, even as the markets are extremely dull, huh? But, let's talk about a bunch of stocks, trades that you should initiate today for a reverse one on Monday. Mitesh Thakkar joins us back. Mitesh, a bunch of stocks moving to the high point of trade right now. From the FMCG pack, it's Britannia, TCS. From the IT pack, Wipro doing well too. Your thoughts?
Okay, Mangalam, difficult for stocks to escape your eye. I have Godrej Consumer on the list. That's the BTST with a stop at 980 or 979 and target of 1005. So yes, the FMCG pack is looking very good, and I think all these stocks are showing at least signs of a short-term uptrend. I picked up Godrej CP purely because it's one of the stronger and the outperforming stock in the entire sector. That's one, and the other one is FSL, First Source Solution. That's the BTST with the stop at 113.9 for targets of 117.
All right, Mitesh, thanks very much. Hopefully you can have a good weekend, and I'm sure it will be more active and more happening than the week has been in the market, right? So you have a good one, and we'll catch you with the markets again next week. Well, with that, let's get back to those highlights that you were seeing on your screens just a while back on the possibility of a brand new category in the mutual fund arena, where the fee or the total expense ratio is going to be determined by the performance. So SEBI seems to be planning to launch this category. That's what we're picking up from sources. Shivani Bajaj has all the details. Shivani?
Sources have told CNBC-TV18 that SEBI is planning to permit a new category of mutual fund schemes where asset management companies will be allowed to charge fees linked to the performance of the scheme. The proposal is still under consultation at the moment, and more details on what kind of schemes will come under this new category are yet to be decided. According to a source with direct knowledge of the matter, SEBI is looking to allow additional charges to be levied by mutual fund schemes that consistently outperform their benchmark index and offer higher returns. This move comes after SEBI recently spoke about rationalizing total expense ratios in mutual fund schemes. Industry sources suggest that this proposal is aimed at encouraging better performance by mutual funds.
Well, extremely important story. We'll come back, and in fact, we'll try to get an update on that front. But the big boy is going to be Reliance Industries. But before we go to that one, ICICI Bank, if you can just pull up the stock price, there were close to 20 lakh shares that got traded in the last few minutes. Remember, there are two stocks that we're looking at. One is ICICI Bank, which comes out with a set of numbers tomorrow. I think 18.5 lakh shares odd have got traded in the last few minutes, and there's a large trade that took place. Interesting to see who were the parties. And the other one is later today, we have Reliance Industries that will be reporting its numbers. So let's get you a preview on Reliance Industries. It's going to be reporting its numbers. Sonia is standing by to run us through the key expectations from the company. Sonia?
Well, it's a big day. Reliance Industries is all set to announce its Q4 earnings. Remember, the stock is down 7% in 2023 so far, but it's a decent quarter expected this time around. First, let me take you through all the key numbers that you can watch out for. On the revenue front, it's about an 8.5% growth that we're looking at compared to last quarter. While on the EBIT, there could be the EBITDA could see a growth of around 5.2%. Margins could be a tad bit under pressure compared to what Reliance did last quarter. But on the profitability front, it's a 12% growth that we're looking at somewhere around 17,700 crores. Now, as I said, both the consumer as well as the commodity businesses for Reliance Industries have done decently well this time around. First, let's take a look at the oil to chemicals business, which is a key reason for the recovery this quarter. There's a sequential recovery that we're expecting for a couple of reasons. A stronger base gross refining margins and lower windfall tax is something that can aid this segment for them. In fact, looking at the gross refining margins, where Singapore gross refining margins improved to $8.2 a barrel in Q4 compared to $6.3 a barrel last quarter. There's also a demand improvement seen because of the China reopening, and that has aided the numbers this time around. In the consumer-facing businesses, Reliance Jio has slowed down a tad bit, so we are seeing the revenue and the profitability growth moderate for them. In fact, it could be the lowest in the last 7 quarters. On the average revenue per user as well, it could be absolutely flat this time around at 178 rupees. A couple of reasons for the slowdown, but primary reason is that there's been an absence of a tariff hike, and that has caused Reliance to see a slowdown in its growth rate in the telecom business. Let's move to retail now. Retail growth is expected to be about 6% on a sequential basis, coming in at a little over 46,650 crores. These are the recommendations put out from Nomura. And on the EBIT side, we're expecting about 3,800 crores versus 3,600 crores last quarter on a sequential basis. So clearly, as you've seen, there's a decent growth expected. Some of the businesses like Rel Jio could see a bit of a slowdown, but it could be offset by good growth in the oil to chemical space.
Okay, well, that's Reliance and all the expectations over there. Let's go across to Sudeep Bandyopadhyay. He's joining in. Of course, he's from Unitrade Capital. Sudeep, thank you for joining in. Two big earnings. The market wonders whether Reliance or ICICI Bank's numbers can move the needle on the index. What do you think?
Well, absolutely. I think we desperately need a trigger for the market to move. So the trigger can definitely come from either or both of these counters. As far as Reliance is concerned, I think, apart from whatever Sonia was mentioning, I will like to also hear the commentary on the financial services business demerger, where it stands, and if they talk about any plans. I will also be curious to understand or hear any commentary from them on their green energy business. I think these are the two areas which market will want to hear quite a bit about. Of course, Jio, we have to see what they talk about as far as the 5G expansion plans are concerned. While there is a long-term potential of ARPU increase through 5G expansion, there is a short-term challenge in terms of cost and incremental borrowings. So we'll have to really see the commentary very, very carefully. As far as ICICI is concerned, bank is concerned, they delivered splendid set of numbers last quarter. All the parameters you can think of, they did beat the expectations and outperformed their past quarters. So, we don't know what next, but yes, things are good for the BFSI. And considering the circumstances, considering the way things have moved, the bank should do well even in this quarter. The only challenge is, unless there is a really breakout performance, the valuation doesn't probably permit a major jump in prices from current level.
Right. Sudeep, your thoughts on Indus Towers. The reason why I ask this because Vodafone Idea are doing extremely well today on hopes of some stability coming in, some credibility coming back once Kumar Mangalam Birla is back on the board after 2 years. Does that mean one should play this, if at all, via Indus Towers, or should one actually look at Vodafone Idea as well now?
Well, I'll be careful, Mangalam, in doing either. Yes, definitely, Mr. Kumar Mangalam Birla joining the Vodafone Idea board is a positive signal for the Vodafone Idea shareholders, and we will hope and pray for some better outcome. Vodafone has been trying to raise capital for the last, 1.5, 2 years almost now, at least what I recollect. And nothing has really materialized. So under the circumstances, unless the promoters are committing funds, we don't know whether fundraising will be easy. And unless there is a fundraising happening in Vodafone Idea in terms of capital infusion, it will be extremely difficult for them to continue, and Indus Towers and other creditors to get their money back in a hurry. So I will wait and watch. Positive development, definitely. Nonetheless, I'll prefer to wait.
All right, Sudeep, thanks a lot for joining in and giving us your insights on the BFSI space and the telecom space as well. Hope to speak to you soon again. But with that, it's time now for a short break. As we do that, here's a quick programming reminder. Our weekend special editors roundtable is coming up at 4:30 p.m. today. Let's get you a sneak preview of what are the themes that we will be discussing today. FIIs have become buyers in April. What is the data suggesting in terms of the kind of sectors and stocks where they were buying? Anuj will join us with the analysis. And as we were saying, there's a lot going on in the electric vehicle space as well, as the Indian government is not in favor of extending the EV subsidy scheme beyond March 2024. Sonia joins in to analyze what this means for the sector and the way forward for the listed players.
Well, we're increasingly seeing firms with lower ESG scores finding favor with investors. Nimesh gets us a complete data analysis on this piece. And I'll also present a piece on analyzing the market trajectory and the key indicators that suggest when the markets have bottomed in the past. So you don't forget to tune in to CNBC-TV18 at 4:30 p.m. later today.
The movie Three Idiots was the first time many Indian households got acquainted with the concept of drones. And prototype of the drone used in the movie was developed by a homegrown startup called IdeaForge. IdeaForge is now a pioneer in the Indian unmanned aircraft systems with a market share of nearly 50% in 2022. The company has nearly 20 patents registered. It has deals with Indian Armed Forces, state police forces, and organizations like DRDO. In April 2022, it backed $20 million in its Series B funding round from several investors, including Florentry, Infosys, and Exim Bank of India, among others.
India is getting excited about the flourishing drone industry as it aims to be the global drone hub by the end of the decade. These steps like liberalization of the drone rules, rationalization of the norms of the drone pilots, and establishment of the drone schools have given new direction to the industry. The recent allocation of rupees 120 crore under the PLI scheme in the recent union budget acted as a booster dose for the Indian manufacturers.
Even just a few years ago, drones were considered a niche industry, but now investments are starting to pour in. Ankit Mehta, the CEO of IdeaForge, which was formed in 2007, has witnessed a complete transformation in government policies and investments throughout the years.
I've in a way seen the drone regulations go from ignore to deny to accept to support. That whole cycle we have seen, right, from the very beginning. And absolutely we are delighted to know that now it is a regime that is enabling. It is a regime that wants to deploy these systems in an environment where we will now be able to take these systems and utilize their benefit without undue bottlenecks around the space we are operating in and the environment we are doing it. As long as we are in those green zones up to that altitude, we are free to operate it for whatever purpose is possible. Of course, we have to take the right set of drones to do those operations.
Apart from the production-linked incentive schemes for the sector, government is using drones effectively in schemes like Swamitwa.
Welcome back another day, and we're going to end as flat as can be, but there were a few winners and losers today. So though the Nifty ended pat with a cut of only around 5 points or thereabouts, and it was a very, very range-bound trade like we've been seeing for the last few days. Let's run you through the list then. Stocks that did well today. ITC, smoking hot as always. That stock, in fact, almost went to around 410 and ending virtually at the high point of the day. So good going out there. HCL Tech came out with a good set of numbers. TCS, remember the stock has seen a fair bit of a correction in the last few days or so. But that stock, in fact, popped up and trade up close to around 2% in trade. Britannia, that was up close to around 2% in today's trading session. And Asian Paints as well was up 1.5%. HDFC was up only around 0.5%. But when that big boy holds up with the green, it definitely helps the Nifty scores. What didn't do very, very well? HDFC Life, well, the numbers look quite good, the operational numbers that they reported. The problem was that the street believes this is a one-time effect. And not just that, they're saying maybe it can impact the growth in FY24 as well. So that's why from starting off well in the green with a gain of around 2%, the stock ended down with a cut of around 3%. Tech Mahindra, some downgrades, some earnings estimate cuts as well, post the numbers that have been declared from some of their peer group. So that was a relative underperformer, down close to around 2.5%. And Adani Enterprises as well was down close to around 2.5% in trade today. Not much action, guys, but the mid-cap index ended lower, but plenty of stocks on both sides of the fence.
Yep, on the mid-cap end of things, one can't say that the index ended flat because we did see some selling. In fact, by the end of trade, we had more number of stocks that declined than the number of stocks that advanced by a factor of 3:2. And if you just take a look at the top losers in the mid-cap end of things, we had the insurance stocks not do too well. So ICICI Pru Post's numbers were down about 3% odd. Overall Realty, again, the same problem as HDFC Life, where good numbers came by, but that was perhaps on account of a few one-offs. So that stock was the top F&O loser today. Dalmia Bharat didn't do too well. Weakness continued for something like a Max Financial, TVS Motors, and Aditya Birla Capital as well. In terms of the stocks that gained, Vodafone Idea, a show of confidence coming in with Kumar Mangalam Birla joining the board once again, so that stock up 6%, and that supported a couple of other ancillaries as well, the likes of Indus Towers. Strides Pharma, Aarti Industries continue to do well, as did Lupin, and we did see some purchase in a couple of these discretionary names like Pidilite, Page Industries, and Bata.
Well, that was pretty much it. I think Oberoi Realty is the one stock that we haven't mentioned, down about 4.5%. That's a big mover on the real estate side of the market. And then you had Vedanta cool off a little bit, 1.5% down. Hindustan Zinc's numbers also came in, so that was a stock in focus as well. Basically, we're wrapping up this week on an extremely flat note. The bulls will have to take heart from the fact that at least the lows of the week were protected. We didn't sort of, crash down through that level of 17,575 thereabouts. That was a low that was made on Monday. But then the bulls aren't able to make any headway, and therefore what we have is a bit of a stalemate. I think 2 days for both the bulls and the bears, both camps to take a breather and recollect their thoughts. And hopefully we have some more headway and some more traction come next week.
All right, well, that's about the markets today, but we've completely run out of time on this edition of Closing Bell. But you don't go anywhere. On the other side, we'll focus on the big news makers of the day. Stay with us.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. Average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points. Now the market share is 17.4%, and for SBI, the loss is about about 111 basis points, with market share being now at 17.9% on a YOY basis. So credit card issuances, SBI card has gained market share by 202 basis points YOY to about 19.65%. Axis Bank, due to Citi acquisition, has gained by 195 basis points to about 14.2%. ICICI Bank has seen a reduction of 175 basis points to about 16.95% now, and HDFC Bank has seen reduction of 190 basis points in the market share to about 20.56%. Top 4's market share in total cards has moved to about 71.06% that you had in March 2022 to right now about 71.4% in March 2023, a gain of 32 basis points, and that was largely for Axis Bank due to the Citi acquisition. Outlook on credit card issuances is that it remains strong in terms of, the credit card distribution on expected line. Spends have increased due to summer holidays. You need to watch out.
Hello and welcome to a special show, the CNBC-TV18 Newsmaker. Well, there is a lot going on in the electric vehicle space. The Indian government is not in favor of extending the EV subsidy scheme, the FAME scheme, beyond March 24. However, a final decision has not yet been taken. EV subsidies to the tune of 1,200 crore rupees have been on hold for more than 13 EV players for close to a year now. Earlier in the day, we caught up with Rajiv Bajaj, MD of Bajaj Auto, to understand his view on the government's stance on the outgoing issues in the space.
I'm not privy to the specific situation of individual companies. It would be very unfair for me to comment. But in general, this is what I would say. As far as localization is concerned, if those norms have been flouted, I think one should consider to the extent to which that's been done. If it's a minor thing, then I think, given that we are all dealing with something new in very uncertain times, for more than just the reason of COVID, I think one should take a practical view of that and move forward from there. If it's more than that, then it's another matter. As far as pricing is concerned, I have a slightly different view on this matter. I have not understood what the logic is for a cap on two-wheeler pricing, for example, to be 1.5 lakhs of rupees, because that is the bone of contention as I understand it. I mean, today you can buy a 20 lakh car and get a 2 lakh FAME subsidy on that, and that's absolutely fine. But I cannot buy a 20 lakh motorcycle and get a 2 lakh subsidy on it. Why? Why is FAME concerned with how many wheels there are on the vehicle? An electric vehicle is an electric vehicle. So I think the bigger issue here is that the government has stipulated something which is becoming a problem. And I would seek, or I would say, that they should try to fix that problem. Because if indeed, and I don't know if that is a fact, if indeed some manufacturers have found a way around that, why would they do that? These are all very reputed companies. Obviously, pricing is a pressure, cost is a pressure. And I'm not saying that that justifies doing something wrong, but I just don't see the logic of 1.5 lakhs. And just to finish on that, let me tell you, earlier this week, I met some very, very senior people in Delhi, government people. And in fact, they believe that this rule is rubbish. So I think if you fix the rule, you fix the problem.
The larger question, Rajiv, is can the industry manage without subsidies after March 2024, right? I mean, how much do you think the industry could get hit? Are we at an inflection point yet where even if the cost goes up by, say, 50, 60,000, it shouldn't matter to a consumer? Or are we still far out?
Well, there's several questions there. 50, 60,000 is, of course, not small for any consumer. In the last 3 years, the prices of two-wheelers have gone up by about that much, as you know, for various reasons. And you've seen how that has impacted demand. So for sure, that kind of a price increase will have an impact. Having said that, I must say that I am not a fan of subsidies of any kind. And I do not think India is going to build a EV future based on subsidies. Look at the last 30 years. as an example. We've gone, and I'm talking of the two-wheeler, three-wheeler industry, from having simple air-cooled two-stroke engines to having four-stroke, four-valve, DOHC, liquid-cooled, fuel-injected engines. We've gone from BS0 to BS6. Surely that has also cleaned up the air a little bit. Otherwise, why have we done it? Now, was there a rupee subsidy offered for this? No. Look at exports. Bajaj has gone from exporting virtually nothing 15, 17 years back to today exporting half of what it makes. Has that been driven by subsidies? Did we get a 50,000 rupee per vehicle subsidy to do that? No. So I don't think businesses build R&D or exports or technology on subsidies. And I don't think, subsidies is going to help. So there's two sides of the coin. On the one hand, therefore, subsidies going away, in my view, should not really have that big an impact in the long run, because the future of EVs in India will be built on the back of sound strategy, not subsidy. Subsidy is not a strategy, and in my view, subsidy disrupts strategy, subsidy masks reality, and subsidy blunts innovation.
What is Bajaj's, just to narrow it down to Bajaj's own strategy on the EV side, if you can explain briefly? And also, export markets, as we all know, and I think you've also alluded to it, are suffering for a variety of reasons. Would you look at exporting the electric Chetak, for example, or on the EV export side, what are the plans?
Hi, Prashant. So our strategy is twofold, to put it simply. One, in our existing business of motorcycles and three-wheelers, we are, working very hard to get the electric three-wheelers out. Basis, as Rakesh has been telling you repeatedly, what we think the consumer is looking for in terms of certain performance metrics. And I think any day now, we are ready to begin, with sales of our e-autos and e-cargos. And again, in the context of FAME subsidy, let me tell you this, that I don't know about trucks and buses, but our math clearly shows that e-three-wheelers are sustainable without a rupee subsidy, for obvious reasons, because the OPEX is very, very favorable. So why somebody finds it necessary to offer subsidies for electric three-wheelers is not very clear to me. So that's one activity we are engaged in, electrifying our three-wheeler portfolio. And the second, as you perhaps are aware, we have a subsidiary now called Chetak Technology Limited, where we have one Chetak, and it will be our endeavor over the next few years to build a portfolio of Chetaks. It's no secret that we are inspired by the kind of work that BMW has done with the Mini, or Piaggio has done with the Vespa, in creating really iconic brands and beautiful products for the world. And our effort is to, make the Chetak brand and the Chetak portfolio something like that. So we will go down that path. For both of these, India is the biggest market, as you know, for two-wheelers and three-wheelers in the world. So largely we will be focused on this market at first, till we get everything right in terms of technology, quality, cost, consumer experience. But at the appropriate time, of course, we will look at overseas markets. Rakesh has shared with you that he has 2 or 3 markets in mind for the near future, but I would not say we have any immediate plans.
All right. Hi, Rajiv. We have heard your views on the electric vehicle space, but, Rajiv, we speak to Mr. Sharma. And the last time I spoke to him with regard to the Triumph, he told me, Nigel, start saving some money. You're going to be seeing it sooner rather than later. So I wanted to ask you, give us more details on the partnership. What kind of, how many models will you be launching in the next few years? Any target out there? Because, as an avid two-wheeler, I love to ride these big bikes. I've been waiting by. And I don't think we have been spoiled for choice in the last few years. So we want to be spoiled. Go ahead.
Okay. So I can put some color on that. The actual launch, I think, will be towards end of June, perhaps specifically on Tuesday, 27th of June in London. It will be a global launch that is being organized by Triumph. What exactly is the content of that, I'm not aware. But that's when the launch might be. So I saw that program where you speculated it might be more towards the end of this year, or someone speculated, but no, it will be in June, which means we should have product in the market in the second quarter of this financial year. Clearly, there's more than one product under development. I can also say that more than one product will be launched in the second quarter if all goes well. Get your checkbook ready, Nigel.
Rajiv, it better be impressive enough. There's an Enfield loyalist biker here sitting.
Who's
Nigel.
looking out? Who's looking out for an option?
So if he's got to make that transition, it better be impressive.
Yeah, we all have to move on in life. He has to move on from the Enfield.
Okay, we're looking forward to that. A launch in London, 27th June, right? Is what you said?
I think so, yes.
Interesting one there. Well, let's take a short break, but don't go anywhere. On the other side, we'll get you the key highlights from our conversation with the management of HCL Tech post their Q4 numbers.
We are so fortunate, almost all of us, that we have no idea what it is like to be on the front line in a war facing bullets and missiles and rockets. What is it like? Let's hear from a soldier who was there, who was fortunate enough to have returned alive, even if he lost a leg. Life as a soldier is never easy, but those were happy days for Mykolaiv Lukai with his buddies on the front lines before the war hit. The war is still here, and so is the trauma for those who have seen the worst of it. I was posted close to Mykolaiv. I was in the Marines. Then we were posted to Mariupol to replace the 128th Infantry Brigade. The invasion we were expecting came on February the 24th. The Russians broke into Mariupol and surrounded us. The ring around us became closer and closer. Then they began to bomb us. Everything around us was destroyed. We ran out of ammunition, food, water. There was nothing left. We put up white flags over our bunkers, and still the Russians kept bombing us, hitting us with rockets. Thousands and thousands of soldiers and civilians were killed. We kept trying to fight the advancing Chechens from the Russian side. We tried to evacuate, but we had been surrounded. I was hit by a shell. I was taken prisoner and then to a Russian dugout. When I reached it, I realized I had lost a leg. I was returned to Ukraine in an exchange of prisoners. I was treated in Zaporizhia and then in Kiev, where I was given an iron leg. I will not be serving in the military for a while, but I will recover and fight again for Ukraine's victory. Walk along the streets of Kiev, of Kherson, of Kharkiv, and not a lot of people have a lot to say. Well, in Kherson, there's nobody.
Welcome back. You're watching us here on CNBC-TV18 News Maker. Let's talk about HCL Tech. That reported a steady quarter with the earnings of the company being in line with estimates, and no negatives was a big positive, as a result of which the stock ended mildly in the green. But the company's management also delivered better than expected revenue growth guidance and spoke about an all-time high order book. We have Reema Tendulkar catching up with the management's, the company's MD and CEO, C. Vijay Kumar, and CFO, Prateek Agarwal.
The year started very well. Second half has been a little soft. And, in spite, if you compare it to our expectations, the couple of verticals, tech and telecom, primarily in our engineering and R&D services, the revenues came lower. Maybe about $20 million came lower than what we expected in engineering and R&D services, and that was mostly attributed to the tech and telecom verticals. As we move forward, I do think most verticals have stabilized, but one thing I want to call out is based on the rigor of execution and the ramp-ups that we have done for some of the large deals that we won in financial services, we expect FY24 to be a very strong year for financial services. And in the mix of business that we have very, very negligible exposure to smaller banks. And we have a very good mix from banking, capital markets, and insurance. And insurance is a segment which is impacted by inflation, and we see significantly large outsourcing opportunities in this segment.
You said you have negligible exposure to the smaller banks. Can you tell us what percentage of your BFSI portfolio is exposed to the US regional bank and maybe even some of the troubled European banks?
Yeah, see, our revenue in BFSI is about 20, and last quarter was about 21%. And of that 21%, only 1%, less than 1% is exposed to smaller banks and the bank that you are referencing. And even within that, there is a run this business spend and the change. So it's really negligible.
So 1% of the overall BFSI portfolio or overall?
Overall BFSI portfolio.
Got that. Prateek, in the press conference, you all said that your aspiration is for 19 to 20% margins. Though for FY22, you have guided for a margin range of 18 to 19%. Can you tell us why you're not confident about achieving that aspiration range this year? Because the supply side situation is improving rapidly and your growth is also going to be fairly okay at 6 to 8%. What would be the margin headwinds to your mind, and take us through the guide path for achieving your margin guidance?
Sure. Thanks, Rima. That's a good question. So let me take a few minutes. I think, first of all, margin expectation and aspiration for the medium term continues to be fairly squarely in that 19 to 20% band. That is the number. 19.6% is what we achieved in FY19 and FY20. So that is what we definitely want to get back to. And like I said in the analyst call yesterday, it is not a question of whether, it is a question of when. Having said that, I think this year definitely has those tailwinds that you talked about in terms of the supply side easing a little bit. But then there is this volatility and uncertainty in the environment that we do need to factor in. And, given that, we've probably got a little used to growing at 14, 15, 16% in a services business. From that perspective, 6.5 to 8.5, though it is good for the current times, doesn't give us the operating leverage that we really need to sort of keep on increasing margins. So all that has been factored into the guidance, and we expect to be within the guidance. And if things do turn out well on the environment, who knows? We could probably beat it as well. Who knows? Fingers crossed.
Okay. Point is taken. CVK, any project cancellations in Q4?
No, nothing to call out. It's normal things here and there. Some cancellations happen, but it's very small.
Got that. In contrast to your peers, CVK, your European performance was a little worse. The growth moderated or contracted, while US surprisingly did well. Can you explain this dichotomy to us?
So Europe, from a year-on-year perspective, has done well. 20% growth in Europe is quite good. But the quarterly growth would have moderated because In the December quarter, we did extremely well in Europe. So from a high base, it would have moderated. But generally, as a trend, I had called out even in the last quarter that the bookings are a little slower in Europe, and we've had a much stronger booking in North America. So that is going to drive a stronger growth performance in North America compared to Europe. And Europe, while the pipeline is good, we do believe some of the deals will take maybe a couple of quarters before they conclude. So then that will have its own revenue trajectory after that.
Prateek, would you like to add why the deal pipeline in Europe is a bit slower and the revenue conversion is also taking time? What, according to you, is the reason for that?
Maybe CVK, you might like to take that.
Even post the kind of conflict, while customers are looking at how to kind of become more efficient, but they're also a little cautious about taking on some very, very big restructuring programs and outsourcing projects. I think that caution is what is possibly driving this.
Okay, so clients in Europe are still cautious about taking very large projects, either on cost optimization or on the discretionary side. CVK, is there a risk that pricing will come under pressure in FY24, at some point in FY24? If all the clients or most clients are gearing and veering towards cost optimization deals, they are going to be trying to squeeze costs on all fronts, which also indicates the kind of money that they give to technology vendors. From an industry point of view, do you think pricing discounts may be something we will start seeing in FY24?
We've had one of the best renewals in the last year, right? Almost 99% plus revenue we renewed. Whichever was due for renewal, we renewed. And if you look at the whole IT spending, there are multiple elements. And when customers want to optimize the spend, there are still many other areas like software, the hardware, and there's in-source spend and outsource spend. Between the four categories, I think there are opportunities in every place. And the outsource spend, I think customers are looking at how can they get more for same or more for less kind of operating model. And they're looking at right shoring, they're looking at higher efficiency measures. And when we provide them those productivity benefits, we're also equally focused on how do we kind of drive that productivity. It does not impact our realization and our overall profitability. How can we constantly be after the automation programs which really delivers those cost savings for our customers? So at this point, there's going to be pressure for sure in this environment. Customers will expect when renewals are coming, they may have a higher expectations, but there's equally good technology toolkit that's improvising for us to help achieve those productivity targets.
So customers are asking for discounts.
Yes, when there is a renewal, obviously there is an expectation to look at higher productivity and higher efficiency. And it's a part of the game.
So like to like last year, were there any pricing discounts?
No, last year, in fact, we were able to increase prices. Our billing enhancement program that we put in place delivered almost 115 million, which is 1% improvement in our margins was attributed to the billing rate increases that we had from our clients.
Well, indeed, that was a steady show coming in from HCL Tech, and the management says that they have a path that they've laid out for the coming year. For the time being, though, the street was pretty impressed with the past quarter's numbers. Well, on that note, though, we'll have a wrap up on this show. Thanks so much for watching.
For March 2023, the credit card spends grew by 28.2% YOY and about 15.7% on a month-on-month basis to more than 1,35,000 crore. While monthly spends are the highest ever for the credit card sector, the credit card issuances also have remained healthy as always. So in March 2023, the credit card issuances grew by 2.3% month-on-month and about nearly 16% on a YOY basis. Card issuance growth is the best in last 9 months. average spends was at about 16,143 rupees, which is up 10.6% YOY and about 13% on a month-on-month basis. So average spends are the second highest that you are seeing post Diwali. Let's look at the top 4 performance. So performance for March, now with Citi's number being in the Axis details, a card market share for the top 4 has risen to 71.37% when compared to 68% in the previous month. Spends market share is at 74.74% for the month of March versus 71.9% on a month-on-month basis. Remember that Axis Bank's numbers now have Citi's numbers as well in March. So spends market share in spends is at 12% for Axis Bank versus 9% month-on-month, a gain of nearly about 300 basis points, while credit card issuances market share for Axis Bank now is at 14.2% versus 11.5% on a month-on-month basis, a gain of more than 270 basis points month-on-month. So in the top 4, due to Citi acquisition, Axis Bank has gained market share in spends by about 321 basis points. Ex-Citi, Axis Bank would have gained market share by 24 basis points. HDFC Bank has gained market share by almost 82 basis points to 27.4%. The top loser is ICICI Bank by about 189 basis points. Now the market share is 17.4%, and for SBI the loss is about 111 basis points, with market share being now at 17.9% on a YOY basis. So credit card issuances, SBI card has gained market share by 202 basis points YOY to about 19.65%. Axis Bank, due to Citi acquisition, has gained by 195 basis points to about 14.2%. ICICI Bank has seen a reduction of 175 basis points to about 16.95% now, and HDFC Bank has seen reduction of 190 basis points in the market share to about 20.56%. Top 4's market share in total cards has moved to about 71.06% that you had in March 2022 to right now about 71.4% in March 2023, a gain of 32 basis points, and that was largely for Axis Bank due to the Citi acquisition. Outlook on credit card issuances is that it remains strong in terms of, the credit card distribution on expected line. Spends have increased due to summer holidays. You need to watch out for the revolver rates, which are on a declining trend for the entire sector. Now, many private lenders are still going out with huge offers on credit card to their customers, so that needs to be seen how that will move ahead. Holiday season could keep the spends on the healthier side. You need to watch out for the inflation if that impacts on the spends of credit card, if any.
The movie 3 Idiots was the first time many Indian households got acquainted with the concept of drones. And prototype of the drone used in the movie was developed by a homegrown startup called IdeaForge.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. The Indian benchmark indices slip 1% this week as IT companies drag the markets lower on the back of weak earnings. The Nifty IT records its biggest weekly fall since December. 31 Nifty stocks post losses this week. Reliance Industries is all set to report its Q4 numbers today. Analysts expect a decent March quarter overall. Jio may see modest growth. The retail segment is expected to put up a good performance. The Reserve Bank has permitted the merged HDFC entity to hike stake in HDFC Ergo and HDFC Life to 50% before the effective date. This will allow them to buy Aberdeen's 2% stake in HDFC Life. Legacy blue ticks disappears. Twitter begins its much talked about purge. Elon Musk puts out a cryptic tweet saying such a great day in so many ways as several celebrities, politicians, athletes lose their verification status. 74% of the Nifty 50 companies do not have active verification as of 4 p.m. today.
Subsidy disrupts strategy, subsidy masks reality, and subsidy blunts innovation.
Bajaj Auto MD Rajiv Bajaj says subsidy masks reality and blunts innovation amidst reports that the government is not in favour of extending EV subsidies beyond March 2024. In an exclusive interview to CNBC-TV18, Bajaj says India cannot build a future with so many subsidies in any sector, reveals the Triumph model that Bajaj is making will be unveiled on the 27th of June in London. Massive search operations underway to trace the terrorists who attacked an army vehicle in Jammu and Kashmir's Poonch. High alert has been sounded in the border districts. The NIA team has visited the site of the attack. Violence in Sudan continues despite the nation's rapid support forces agreeing to an Eid ceasefire. The country's army chief makes no mention of truce in a TV address. Prime Minister Modi chairs a high-level meeting to review the situation of Indians stuck in Sudan.